there is spectacular amounts of volatility.
It feels like we should kind of sit on the sidelines for a moment here.
The market is looking for just what the off-ramp could be.
This doesn't feel like the beginning of a great year.
Eventually, that volatility will create great buying opportunities.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday following crude volatility.
This was just an excursion into something that had to be done. During this brief disruption, we're way ahead of schedule, and it's going to be ended soon. And if it starts up again, they'll be hit even harder.
The president's verbal intervention slamming the brakes on a major oil rally, even as key producers across the Middle East are continuing to cut output, and Iran's military is showing little sign of looking for an off-ramp. We begin this hour following a wild swing in crude from almost 120 at the highs before plunging into the 80s at the lows. One line from the president, whipsawing investors, "I think the war is very complete." Pretty much. The verbal intervention capping energy markets, the reality on the ground curbing some of the enthusiasm. Across Saudi Arabia, UAE, Kuwait and Iraq, oil production cuts are totaling about 6.7 million barrels per day. The squeeze on supply continues.
My question is, how tradable is this market? As you mentioned, on a fundamental standpoint, that's about 6% of the overall market supply in the world. That is a significant hit. At the same time, people can look past that if they can understand some sort of forward trajectory. Well, good luck with that when it can be dictated by a single comment.
Amin Nasser, Saudi Aramco. This quote right here. I've spoken to Amin in the past, pretty conservative guy. Not the kind of guy that makes things sound more dramatic than they actually are. This one by far is the biggest crisis the region's oil and gas industry has ever faced.
Yeah, and he goes on to say there would be catastrophic consequences for the world's oil market the longer the disruption goes on. So once again, this is about the timeline, not necessarily just the production output cuts right now, which goes to the statements that are whipsawing markets in record form. At what point can you get a sense of an off-ramp until there is real policy behind it?
Just go through things piece by piece in the last 24 hours. Direct verbal intervention from the president. We saw the G7 finance ministers open to releasing reserves. A report from Reuters that the White House is considering a range of offsets as well, and a vague throwaway line about sanction relief as well. But what have we actually done? The answer to that is not a lot.
Which is the reason why I think there is some skepticism. And again, it goes back to how much conviction can any trader have when you have a $36 swing in Brent crude in one day, the second biggest on record. You start looking at those types of swings. You start looking at the fact that Millennium, Balyasny, and Point 72 have all suffered massive losses. You think about momentum bets that have been stopped out. At this point, this is a difficult market to get conviction, and that's the reason why, even if there are statements that sound good, you are not going to get the stability that so many investors are looking for.
Looking for stability in the equity market. Equity futures right now in the S&P positive by about 0.2%. Coming up this hour, we'll catch up with Nate Turth of Manulife, with markets whipsawed by geopolitics. Stephen Kirk of the Council on Foreign Relations as the president signals an early end to the war. And Stephen Schork of the Schork Group following crude's biggest intraday swing on record. We begin this hour with our top story. President Trump saying the Iran war's objectives are nearly complete and the war could be resolved very soon. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, good morning.
Hey, John, good morning. Well, President Trump is suggesting an early end to the war, but cautioned that it's not over yet. The president maintains that the U.S. is ahead of schedule in achieving its military objectives, but went on to say he doesn't think that the conflict will resolve this week. He says the U.S. military campaign will not stop until he is satisfied that Iran will not be able to obtain a nuclear weapon, saying in part, quote, the U.S. has won in many ways, but it hasn't won enough. Now, the president did also threaten to expand the list of military targets to electricity infrastructure if disruptions to the Strait of Hormuz continue. He reiterated the U.S. Navy stands prepared to escort tankers through the critical waterway, which remains effectively shut with no finalized plans from nations to safeguard ships. And new this morning, Bloomberg News now reporting that it appears electronic warfare is jamming signals in the strait. As oil remains top of mind, as you mentioned, the president mentioned yesterday that we could see some oil-related sanction waivers, though he didn't provide many details beyond saying that he discussed the possibility in a phone call yesterday with Russian President Vladimir Putin. John, people familiar with the matter tell us here at Bloomberg News that the administration has been mulling several potential options to help out with prices in recent days, including a potential federal gas tax holiday or even dipping in to emergency reserves. I will point out we got a statement yesterday after President Trump's comments from the IRGC maintaining that it will continue to block oil exports until the U.S. stops attacking Iran.
Tyler Kendall with the latest. Tyler, thank you. There's a story I often tell about August 2019 when the President of the United States, you know where I'm going, don't you? When the President pretended he had a call with the Chinese. And it was always about the signal and not about the substance. Because for a lot of people, that meant the President was looking for an off-ramp. It wasn't about whether the call had happened or not. The Chinese never verified the call. And I wonder how similar things are this time around. The difference between the signal and the substance. The signal is, for many people in this market right now, they believe the President is looking for some kind of off-ramp to confront this massive move in the energy market. The problem with this, unlike the tariffs, where the President was in almost total control, this isn't just about the US. It's also about Israel, and it's also about Iran. And to sit here and say things are going to end soon takes more than one person to say things are going to end soon.
At the same time, I think people are just trying to get into the mind of President Trump and hope that that's enough. But you're absolutely right. It's not.
Let's get to the view on Wall Street this morning. Nate Thooft of Manulife writing, we could see economic growth diminish if policy uncertainty increases. Corporate profit margins get crimped due to higher energy input costs, and higher gas prices will act as a consumer tax. Nate joins us now for more. Nate, good morning.
Thank you for having me.
What is the price for all this volatility?
I mean, I think the reality is we have a big pogo stick going on, right? We have a lot of up and down, and we don't have a lot of forward traction. And the uncertainty is very, very high. I think the price is that we live in a world where volatility continues to be the theme, at least in the near future. This, to your point earlier, the signal is there, and everyone wants this to conclude quickly and the duration of it to be limited. But the reality is the on-the-ground activity and the idea that multiple players are involved could lead this to last a lot longer than many people think.
You've heard the comparisons to 2022 and this moment right here. What do you think the major differences are?
I think the comparison is that you have energy prices going up. What we don't know yet is the duration of that or the infrastructure and how wide that is, let alone the escalation, right? There's three big things there that we don't have the answer to. 2022, we saw this dynamic where oil went up for a period of time. We saw interest rates go up for a period of time. And then eventually things pass. I think this time around, you're probably in a similar scenario where you do see some damage in the equity markets for a period of time. But ultimately, we flow through it and we have to focus again on the underlying fundamentals, which are going to be much more positive.
Well, people are treating this as though it's an inflationary shock, the way that 2022 was. Why don't you see it exactly that way?
Well, this time, I think, one, we've experienced it before. And the markets, as they've seen one thing before, they start to accept the fact that that's a possibility and are less concerned about it. The other thing, I think, when you think about it, is when we look at the dynamics here, oil, while very important to economies globally, there is solutions to this, and we do think there will be a de-escalation at some stage. It's a question of timing, right? And the longer we stay at high oil prices, let's say 100 or above, the more impactful it is to growth rates and inflation. We believe that from a developed markets perspective, if you stay above $100 a barrel for, let's say, a handful of months, you're arguably going to decrease growth rates by about 0.5% a year, and you're going to increase inflation rates about 1% per year for most major economies. That's very detrimental to the markets, both from an interest rate policy perspective, but also from an equity perspective.
It's been treated like a stagflationary shock, which includes people selling long-term bonds. It seems like what you're talking about is somewhat of a different prescription. Why?
Well, I think that why it's a bit different is I think this is short term. I don't think this is a secular theme that we are going into a stagflation period that's going to last multi-years. I do think ultimately you're going to have central bank policy members look through this and say, hey, we care more about jobs, we care more about growth, and we're willing to look through a temporary shock attached to higher oil prices if necessary. That's not their preference, but they are willing to if it's necessary. And ultimately we get to a point where we have energy prices get back to a level that's more stable and not at this 90 plus or 100 plus level. And I think that's where the market is hoping for. And I think that's what most policy as well as political members out there think. We will still be in an environment where we will get to a solution here where we don't have to see the worst case scenario.
What do you think that means for the stock bond correlation?
I think that's a problem. I think the stock-bond correlation has been a problem and will continue to be a problem. And this is why we continue to look for ways to improve portfolio construction beyond just relying on interest rates or lower interest rates being your insurance policy.
Where do you go then?
You go to areas like commodities, as an example. That has been a good hedge in these types of environments. You go to things like gold, which maybe is not working as well in the short term here, but has been working very well over the last couple of years. And you look at other types of alternatives.
Why do you think gold's not been working well?
I think gold hasn't been working well, partly because it had been working well, right? It had worked very well for the last 2 years. You had a lot of players in there. Some of those players decided to exit either for liquidity reasons or for reasons that they made a lot of money and they want to protect their profits, right? And then you also had what appeared to be the two classic things that did work, which was the U.S. dollar, and you had the overall dynamics of the market, such as oil, because that centerpiece of the geopolitical concern work. And so the trades moved into that.
If I'd asked this question 12 months ago, you would have thought I was insane. Is 5K a good entry point to buy gold?
I think it is.
Yeah, 12 months ago, that would have sounded nuts. But now this is a good opportunity.
We still believe that secularly we will see higher gold prices over the next several years.
Going forward, I'm just wondering if you are ratcheting back your returns profile more generally overall, whether you think that investors have to expect that in a reindustrialized world with a higher rate of potentially inflation, but also lower growth, this means that you're just not going to get the same kind of returns.
You absolutely have to dial back your expectations. The reality is we are now in a world where equity valuations are high. We have uncertainty around yields, and they may not go down a lot. And so I think your expectations for total return from your portfolio, whether it's from the fixed income side or the equity side, have to be lower than what we've seen over the last 20 years.
Is the U.S. still the safe haven market?
I think for the time being it is. But I do think once we get through some of this more geopolitical dynamic right now, I think we are going to go back to a trade where you do see diversification outside the U.S., dollar dynamics start to be more on a back foot, as in dollar starts to depreciate again. So we think ultimately over the next several years, you are better served having a more diversified portfolio. But in the short term, US dollar is a safe haven trade that does provide some level of hedge.
Nate, it's good to see you. Thanks for dropping by.
Thanks for having me.
Nate Thooft there of Manulife Investment Management. That inverse correlation between the dollar and risk really started to kick in over the last few weeks, which flew in the face of some of the things we heard, 2 months ago in Davos, Switzerland, south of the US?
It was potentially the most painful trade that could have happened, given how offsides everyone was caught, and it only escalated the strong dollar position. And now you're seeing all these notes flood in saying, now the feeling is those have all been washed out, get long the dollar, and here we are starting the year all over again.
The international stock story has been quite a ride. The Nikkei and the South Korean Kospi getting absolutely hammered in the last couple of days. The Nikkei 225 in Tokyo actually bouncing back this morning, higher by 2.9%. Equity futures doing just about OK on the S&P 500. Up next on the programme, I'm going to end to the war.
We took a little excursion because we felt we had to do that to get rid of some evil. And I think you'll see it's going to be a short-term excursion.
Are you thinking this week it will be over?
No,
Are you talking
but soon.
about days?
I think so.
Up next, Stephen Kirk of the Council on Foreign Relations, live from New York City this morning. Good morning. One line for the President of the United States. I think the war is very complete. Pretty much. Equity futures look like this, a big bounce off Monday's low. Equity futures positive by 0.2% on the S&P 500. On the Nasdaq, up by 0.3 on the Russell, up by 0.1%. Just about avoiding a third day of losses to kick off Monday trading. A kick-off trading this week, and what a ride we've seen already in the commodity market. At the highs, almost 120. At the lows in the 80s. Brent crude down by 7% this morning at $92 a barrel. Now, a few weeks ago, 92 meant something. That was much higher than where we were. But 92 compared to where we were Sunday evening, that's a bear market.
It's amazing that the market can decline by 10% purely on President Trump saying, I think the war is very complete, pretty much, as you just said, saying that the U.S. is very far ahead of schedule. Then he went on to say, we haven't won enough and that the conflict won't end this week. So a very difficult backdrop for people to get any confidence in.
Some contradictions in those statements yesterday, but ultimately the market heard what it wants to hear. Under surveillance this morning, eyeing an end to the war.
We took a little excursion because we felt we had to do that to get rid of some evil. And I think you'll see it's going to be a short-term excursion. We're winning very decisively. We're way ahead of schedule.
Are you thinking this week it will be over?
No,
Are you talking
but soon.
about days?
I think so. We could call it a tremendous success right now as we leave here.
So here's the latest this morning. President Trump hailing significant progress in the Iran war, saying the military objectives are pretty well complete. Joining us from Dubai is Bloomberg's Jumana Basechi. Jumana, do the facts on the ground contradict the statement from the president in the last 24 hours?
Well, I think everyone in the region is taking it with a pinch of salt, and not least because the messaging coming out of Iran continues to be one of defiance. Just in the last hour, we had the Speaker of the Iranian Parliament put out a post on True Social saying that they have absolutely no desire to go for a ceasefire. Overnight, the Iranian Foreign Minister Abbas Araghchi also once again warning neighboring countries that if they hosted U.S. assets, they would be liable to attacks. And they say they should not complain if the Iranian missiles destroy U.S. systems on their territory. And indeed, even though we've spoken about the intensity and frequency of the attacks coming through from Iran onto GCC countries as having diminished over the course of the last few days, that doesn't mean that they're still not firing drones. These are being intercepted. Over here in the UAE this morning, we also had a missile interception alert overnight in Bahrain, more damage being leveled at residential buildings, some civilian deaths coming through. Saudi Arabia is still intercepting missiles as well. So there is still ongoing attacks going on in the background. At the same time, when you think about the economic disruption, for all intents and purposes, the strait is still closed. And a spokesperson for the IRGC said that not 1 liter of oil is going to pass through the strait so long as the U.S. and Israeli military operations continue. And I just want to draw on some really noteworthy comments that we had from a very influential industry leader, the Aramco CEO, making some comments on the earnings call today and calling this catastrophic. He said the disruption that we're seeing could have catastrophic consequences for the world's oil markets the longer this goes on, and it will be more drastic for the global economy. And then he adds, while we have faced many disruptions in the past, this one by far is the biggest crisis the region's oil and gas industry has faced. So just to give you the severity, the magnitude of the type of disruption that we're seeing, and no letting up in sight, I will say, despite the President Trump's comments overnight.
Hey, Jumana, it's quite a statement. I couldn't agree more. Jumana Basechi there, leading our coverage out of Dubai. Jumana, stay safe. The hopium came yesterday. The reality check out of the Middle East came this morning.
Yeah, on two fronts, on both the IRCG and their comments about how it's not over till they say it's over, but also this idea of output cuts that are significant and some of the projections coming from the oil executives in the region.
Almost 7 million barrels of oil per day production cut that we've seen across several nations in just the last week. Stephen Cook of the Council on Foreign Relations writing, we should be prepared for messy endings. Iran's fractious opposition politics produces instability. Stephen joins us now for more. Stephen, welcome to the programme. You've heard this line many times. Wars are easy to start. They're difficult to win. To what extent is the end of this war in the president's hands?
Well, I think that the president was accurate in saying that the United States has been successful tactically. Clearly, the Iranians are no match for the combined military power, I should say, of the United States and Israel. But they have demonstrated that they still have considerable fight left in them, attacking GCC states and beyond. I think the big mystery for analysts like myself is why the United States hasn't taken more proactive military measures to ensure the Strait of Hormuz is open. For as long as I've been working on the Middle East, which is now a long time, I've heard that any effort to close the Strait of Hormuz was going to be met with overwhelming American force. We've used overwhelming American force throughout Iran, but not necessarily to keep the strait open.
There has been also a question about the SPR in the U.S. and why it hasn't been filled. John was mentioning that yesterday. I'm just wondering how you assess the conflict. We've heard things from President Trump about where we stand. Does it feel like it's wrapping up, like it's culminating, like it's past its peak violence?
It does not. Clearly, the United States and Israel still have target lists. The Israelis certainly would like another few weeks to try to crack open this regime. And as I said before, the IRGC continues to have fight in it. But none of those things matter as much as President Trump's gut. And I think in true fashion to the president, he's keeping all of his options open. And I think that's what we heard in the news conference and statements coming out of Florida yesterday. He could call it a tremendous success and end it now, but we're going to have more victory. Is it ending soon? Well, not this week. I think he's going to decide, and the inputs that help him decide are gasoline prices, how his base is responding, what the stock market is doing. So it doesn't feel like it's over. We're past peak violence if you look at the battlefield, but we could wake up tomorrow morning and the president could declare victory.
Would that be enough? Can he turn the tap off?
Well, what would happen was we'd go back to some ugly form of the status quo ante in which the regime has suffered a significant amount of damage, but continues to threaten its neighbors and hold a veto over the free flow of energy resources out of the Middle East, which is a core national security interest of the United States. So we would have weakened the regime, but we would not have solved the problem that Iran presents to both the United States as well as America's partners in the region.
Stephen, as the war continues, one notable feature of the retaliation from Iran has been all the projectiles and missiles that have been heading to other Gulf nations. Over the last week, we've continued to ask the question, how will they react? What's your read on things as to whether they will step in and engage in the conflict, or whether they'll continue to put pressure on partners like the United States and maybe put pressure on Israel as well to step back?
Well, so far that hasn't happened. That's clearly been the Iranian strategy, is to do a lot of damage to its neighbors so that they put pressure on the United States, and the United States puts pressure on Israel to bring this thing to an end. But I think the Iranians miscalculated, and so far Gulf leaders are outraged at what the Iranians have done, particularly the massive waves of attacks on the UAE and the damage that's been done to Bahrain. So far, we haven't seen that pressure. We are hearing from oil executives in the region. You mentioned the Aramco CEO saying that this is catastrophic. There may be a turn, but so far the GCC states are hanging tough. And as long as the United States and Israel are making military progress, they are not going and don't seem to be inclined to ask the United States to call it off.
Stephen, when people say the United States, we know who they're talking about, the president. When they say Israel, we know who they're talking about. When we say the Iranians, who are we talking about anymore? Who's leading this?
Yeah, well, it's clearly now an IRGC state. Mojtaba Khamenei, the son of the now late Ayatollah, is really a creature of the IRGC. And this, if the regime does not fall, this is what the United States and other partners in the region are going to have to contend with. There are questions about the command and control. Why would the Iranians hit Gulf states after the Iranian president apologizes to said Gulf states? But nevertheless, it seems that the chain of command within the IRGC remains somewhat intact, and they are able to fire. So this is very much the regime that the United States, at the initial outset of this conflict, a little more than a week ago, called for the end of.
Stephen, it's good to see you. Stephen Cook there of the Council on Foreign Relations. That was one of the contradictions of the weekend, I think, for me, that the president was saying one thing and the military was doing something completely different, which speaks to why when we talk about the Iranians, we have to be very specific about who we're talking about right now and who's leading the response, because it's not the president. It seems to be coming from elsewhere.
And do we have maybe this idea of who's in charge right now in Iran? There are all sorts of rumors and reports. I found it very noisy out there when I try to get information. We also should take a look at if there is resolve in the Middle East to try to stave off the regime from coming back in the same way. what could the potential future be on the bright side in terms of oil supplies and in terms of stability for the region? I mean, this is what people are trying to hope for as well.
So on the bright side, when it comes to oil prices, they are declining this morning. We're down by 7% on Brent, 91.50. On WTI, we're down about 6 to 7% at 88.30. Up next on the programme, we'll catch up with Stephen Schork of the Schork Group on the massive swings in crude. Plus, Lizzie drops by. She's got your morning movers. Energy producers falling alongside the cost of crude. Truly a historic day in financial markets in the last 24 hours. This trading range right here on crude, 119.50 at the high, 83.66 at the low, a $26 trading range. Shout out to Alex Longley of Bloomberg News for this one. From intraday high to closing price, the largest drop on record for crude.
I love some of the commentary from traders who are in the market. What markets are experiencing right now is not just volatility, but a sense of helplessness. How do you understand a market when it's swinging as though it were just sort of swinging in the wind? It's penny stock kind of behavior, and yet it's a massive market with a lot of seasoned traders who are not really trading on fundamentals.
At the mercy of the price of crude. Crude this morning down by 7%. Equity futures positive by 0.25% on the S&P 500, up by 1/3 on the Nasdaq. On the Russell, up by about 0.2%. Avoiding a third day of losses on the S&P 500 in yesterday's session. Consumer-facing names getting some relief given the turnaround in the price of oil. Airlines snapping a 6-day losing streak, and airlines have had a tough run of it.
They have a double whammy of both people who are worried about traveling during a time of conflict and uncertainty, and then also oil prices surging, the idea of how much this would really crimp their profit margins, getting a bit of a reprieve. They are the template, sort of the harbinger of the macro economy. So when the macro economy is swinging the way it has been, so too are their stocks.
Jet fuel and delays. The delays pretty brutal as well over the last couple of days. It's not a good time to be flying at all, is it?
I mean, honestly,
it's really not.
Whether it's weather, whether it's the snowstorms, whether it's the Middle East, it's been a rough go of it.
The never-ending first quarter continues as we count you down to the opening bell about 3 hours away. Let's get you some single names, some morning movers. Lizzie has more. Hey, Lizzie.
Hey, John, we have to start with energy. It's the opposite story to yesterday. As you say, today we've got oil down off the back of President Trump's commentary on the Middle East, and the energy names are suffering today. But the oil price drop really is the reason for the relief rally elsewhere, and that is a better backdrop for the earnings that Oracle will be dropping after the bell later. So flip the board over. Oracle is up in the pre-market ahead of these numbers, up by nearly 2%. At this point. Of course, it's hard to find many stocks that have been more battered by the AI scare trade than Oracle. And so the question becomes, with these earnings, no matter how good they are, how much will the stock be punished if traders deem their capex plans too aggressive? But we've already heard from Oracle posting on X earlier this morning saying that any worries about their AI data center build out are for the birds, and that their flagship Abilene site is going to run on schedule. Speaking of data centers, though, finally, TSMC, of course, the go-to chip maker for NVIDIA and AMD, Broadcom, it is up in the pre-market. We've already had sales numbers from this company up 30% in the first 2 months of the year, lifted by the robust pace of AI infrastructure construction before the war in the Middle East broke out. The question now is, can it continue apace, given that data centers have been targeted as part of critical infrastructure? John.
Lizzie, thank you. Thank you for the update. Lizzie Burden out of London this morning. On our radar this morning, crude falling as President Trump vows to keep the Strait of Hormuz wide open.
I will not allow a terrorist regime to hold the world hostage and attempt to stop the globe's oil supply. The Strait of Hormuz is going to remain safe.
Well, it doesn't seem to be safe right now. The president later posting on social media, quote, "Death, fire and fury will rain down on Iran if it continues to block tanker traffic." Elsewhere, Gulf oil states deepening production cuts as the Strait of Hormuz remains all but shut down. Saudi Arabia, Iraq, Kuwait and the UAE cutting output by nearly 7 million barrels a day, amounting to 6% of global supply. And G7 energy ministers meeting today to discuss the possible release of oil reserves. The summit coming a day after finance ministers considered a coordinated release, determining it was not yet necessary.
Yeah, so what would trigger them? And they are meeting yet again, 1:45 p.m. local time at the International Energy Agency in Paris. The commentary from the French finance ministry saying we are going through the process, but obviously all options are on the table. Even if they don't come to some determination, the fact that they are meeting and discussing this is enough to at least provide a little bit of a buffer against some of the swings. Even if it's unclear exactly what they would do, it indicates psychology. It goes back to what you were talking about, the psyche of leaders and the response function to some of the oil price surges. Clearly it's an issue, clearly it's a political issue, and clearly they are preparing for some sort of response.
Yeah, the signal, not the substance. I thought the signal coming from the Reuters report was interesting. I'll read it to you if you missed it. Options include restricting US exports, intervening in the futures market, we've heard that before, waiving some federal taxes and lifting requirements under a US law called the Jones Act, the domestic fuel move only on US flagged ships. That was the Reuters reporting just yesterday.
Yeah, and of course the Jones Act got a lot of memes on X or Twitter or whatever you want to say. I am also very curious about restricting exports to other allies, because that is something that really plays into the hands of what does Europe do? Not only with gasoline, but liquefied natural gas, given that the U.S. has really supported some of the oil supplies, natural gas supplies that have previously been coming from Russia.
There are some options on the table. Those options on the table are moving the oil price around, but no one's chosen an option just yet. Crude is lower by about 6% this morning, $92.50 on Brent crude. The president pledging to keep the price of crude lower.
I knew oil prices would go up if I did this, and they've gone up probably less than I thought they'd go up. We're also waiving certain oil-related sanctions to reduce prices. When the time comes, the U.S. Navy and its partners will escort tankers through the strait if needed.
Crude coming off its biggest intraday swing on record. Stephen Schork of the Schork Group writing, if Hormuz remains functionally closed, the base case absent a ceasefire, the upper tails for Brent and WTI come into focus. Stephen joins us now for more. Stephen, what is your sense, your read? How much visibility do you have on what is actually going through the strait right now?
Yeah, absolutely. I mean, we can talk about keeping the Strait of Hormuz open. We can talk about raining hell and fire down in Iran if they decide to close it. But effectively, if you can assure a tanker going through Hormuz, you're not moving oil through the Strait of Hormuz. So effectively, we've had our blockade. We're about, what, day 9, day 10 into an effective blockade. So that's 20 million barrels of oil that is not making it to the seaborne market. So we're looking at a significant shortage of oil, regardless of the rhetoric coming out of both Tehran and Washington, D.C. Effectively, we're looking at 2, at best case, 3 weeks, and I'm being optimistic there, of a significant global shortage of oil. If we do not get that strait flowing with a significant amount of restoring the oil, that typically flows there on a daily basis.
Stephen, where and in what do you expect to see that show up first? In Asia, in oil product? What are you looking for?
Yeah, absolutely. We're looking for it, and we're seeing it now in Asia. Now, of course, there's the talk about release of the SPR. We are at about, between the United States and Western European countries, we have about 1.4 billion barrels sitting in reserves. If you release that oil, realistically, you can get about 5 million barrels a day onto the market. That would supplant a quarter of what has been lost through Hormuz. But the bottom line is its location. That oil, if it were to be released, gets released in the Atlantic Basin. The oil that comes out of the strait mainly goes to Asia. So look at the Asia markets. And we're looking at that. We're looking at the Dubai market, which is a marker for the Asian market. It's a sour oil, trades at a discount to Brent, typically, because it's an inferior oil, but it's trading now at a $10 premium in the spot market relative to Brent. So that is clearly a telltale that Asian refiners are scrambling to get heavy barrels to replace the Arab heavy that has been lost through the strait. So we're clearly seeing it now in Asia with that inversion of the Brent-Dubai spread. However, when you start to look at further out, when we get to the month of June, Brent is now trading at a $10 premium to Dubai outgoing this summer. So that's the market's way of telling you they expect to see some sort of resolution with the Strait of Hormuz and ease into Asian refiners between now and the month of June.
Stephen, how difficult is it to trade in this kind of market?
Oh, it is. Well, it looks. I mean, it makes Bitcoin look like a, just buying IBM stock and just holding it. It just makes Bitcoin look stable. So no, this is a market where you just really have to keep it very, very tight stops. At this point, you cannot go take any major position when you have a market that's literally moving yesterday $30,000 per contract. That's going to make or break people significantly. So that's what we're seeing now. And there's the rumors of as the U.S. Treasury interfering and coming into the market and trying to short the futures. All sorts of speculation out there. We have no roadmap. We have no resolution to what's going on in Iran. We have the president of the United States saying, "Oh, this could end soon," but then again, we still have Iranian generals out there as if they're auditioning for the role of the Black Knight in the reboot of Monty Python and the Holy Grail. So there is still a lot of chaos out there. So you have to keep your stops extremely short, your positions extremely small to get in and to get out. The opportunities are there when you have a market that's swinging $20, $25, $30 a barrel, a tremendous amount of opportunity to get in and out, but it's a tremendous opportunity to get burned. So we've never seen a market like this. And we're talking about June 2025 with the 12-day war. We're talking about 1991 with the invasion and kicking Iraq out of Kuwait. So we've had a lot of upheaval in these markets over the last 2 generations. We've never seen anything like this. So to take large positions out there is akin to a death warrant.
Stephen, I just wonder, looking forward, once, let's say, there is a resolution and supplies have been restarted, we keep going back to the point that Jeff Curry over at Carlyle Group made, that there's going to be a risk premium sort of baked into physical commodities that have to transport on the seas, not to mention oil in particularly. Do you agree? Do you think that we're going to set at a higher price just simply because there is this risk of disruption that was just thrown into cold relief?
Yeah, absolutely. Well, if we do see a resolution, if we look at what the risk premium currently is, we look at the spread between implied and historical volatility. Historical is where the variance in price has been. Implied is where options traders think that the premium is going to be. And that spread premium is now, that risk premium is now well over $7 a barrel. It's increased $5 a barrel above where we were at the start of this. So there's already significant risk premium priced into the market. We're seeing it now also in the formation with the steep backwardation. That is to say, prices have spiked in the nearby months relative to the outer months. So therein lies that premium of securing, and this is the market's a way of going in and securing those barrels and hence bidding up the prop market. So when we do look at the forward curve, when we do look at the spread between implied and historical volatility, we're looking at between if we look at the term structure, a $5 risk premium baked in, and that is the increase we've seen in the options market from about a $2 premium to $7 premium. That is where it is now. But if we get the kind of resolution we're hoping to see, i.e. a regime change to a positive government, which is a long ways off, well, clearly, I think that is a signal that peace is at hand. And I would expect to see that price premium exercised out of the market in the blink of an eye. But that remains to be seen. We have a long way to go before we get from there to a peaceful regime in Iran.
Well, Stephen, before you go, as this conflict continues, let me pick up on that Reuters piece once again and some of the options available to intervene to reduce crude prices. They include restricting US exports, intervening in the futures market, waiving some federal taxes and lifting requirements under a US law called the Jones Act, that domestic fuel move only on US flagged ships. That verbatim coming from Reuters just yesterday. What do you think is the realistic option there on the table?
Well, the first one of restricting exports is idiotic because we simply don't consume the type of oil that we export. We have no use for it because our refineries aren't engineered to use that oil. So if we don't put that oil, we keep it for ourselves. We're keeping it for ourselves, but we can't use it. With regard to intervening in the futures market, try and sell it. Well, you're trying to tell me that the United States, the U.S. Treasury is bigger than the global market for oil. Quite skeptical on that as well. So if we want to, reduce some taxes and other sort of gimmicks, at the end of the day, John, they're gimmicks, and none of them are any sort of resolution to getting oil flowing through the Strait, which is where we need it. So no, I don't see any of these gimmicks having any sort of positive impact on prices at this point.
Well, Stephen, given the extreme backwardation in the curve that you explained, why wouldn't a lot of these authorities just sell the reserves into the market and buy further out along the curve? Why wouldn't they do that?
Well, absolutely, and that is what's being talked about 1.4 million barrels. But again, so we're talking about that oil. Where is it getting released? Essentially into the Atlantic Basin, where we do have the Atlantic Basin is not short of oil, and this is what's being priced off of the ICE Brent crude oil market or the NYMEX WTI market. So where we need that oil released would be in Asia, and getting oil from the Atlantic Basin over Asia is an arduous process at this point. So it makes for a great sound bite, and we probably will, seeing at the given spreads, but it will have a limited impact on the markets where we really need to see that oil.
It's a good point, Stephen. Thank you, sir. Stephen Schork there of the Schork Group. Crude this morning down by 6%, Brent at 92.50. Lisa mentioned Jeff Curry. Jeff's going to join us tomorrow, so looking forward to that conversation. His recent note, every major importer is securing supply simultaneously. We estimate that precautionary demand could be 2 to 3 million barrels per day over the next 3 to 6 months. The physical disruption is the trigger. The behavioural response is the multiplier. And I think it's the behavioural response that you're really thinking about.
Yeah, we're back to storing oil barrels in our living rooms. There's an issue, though, not just with oil, but more broadly. If you could see disruptions to the supply chain, as we've seen time and time again, why wouldn't you carry more inventory if you can, especially if it is a commodity and not necessarily an item of clothing that's going to go out of style? And that, I think, is the behavioural multiplier that he's talking about.
Let's keep it on the markets. Futures this morning positive by 0.2%. Up next, calming the bond market.
Global bond yields are moving quite dramatically higher. This global bond yields moving higher is going to keep treasuries higher as well. But I just don't see treasuries really breaking out of the range on either direction.
Up next on the programme, Kadota of Barclays from New York City. You're watching Bloomberg TV. Following something like a $26 trading range on the crude price in the last 24 hours, at the high 119.50, at the low 80s. Crude looks like this right now. Brent and WTI down by 7% and 6% respectively. Brent crude at 91.84, WTI at 88.89. In the equity market, futures shaping up as follows going into the opening bell later this morning. Futures positive by 0.1% on the S&P, on the Nasdaq by 0.25. Things were pretty unsettling Sunday evening. Ed Yardeni of Yardeni Research writing, if investors start expecting stagflation, a bear market is more likely.
Yeah, and he increased his chance of that, turning to 35% from 25% just a day earlier. It was moving quickly, he said, because the price of crude was moving so quickly. How have we taken that off the table? And I think that's a key question as we parse through different Truth Social posts as well as different rhetoric.
The bond market stuck between a rock and a hard place. Under surveillance this morning, calming fixed income.
Global bond yields are moving quite dramatically higher. This global bond yields moving higher is going to keep treasuries higher as well. But I just don't see treasuries really breaking out of the range on either direction. So yes, it's not a good flight to quality hedge in this environment, but I also don't see treasuries really moving out of the ranges that we've been in the last few months.
So here's the latest this morning. Global bonds rebounding on signals the Iran war might be coming to an end. Kadota of Barclays writing, with a channel for upward pressure on yields led by inflation risk premium in place, geopolitical headlines remain in focus. Shin joins us now for more. Shin, welcome to New York.
Thank you.
It's good to see you. Thanks for being here. Let's talk about Japan and Japanese bonds. Typically, yen assets are a haven asset, but then you've got the fact that we've got a term to trade shock for Japan as well. How are they behaving given this shock right here?
Yeah, sure. So in the reaction to the earlier this week on the rise of oil towards 120, Japan's market was basically seeing yen selling off. As you say, the terms of trade shock was overweighting on the safe haven demand for the yen, and then the rate was twist steepening on expectation that the BOJ's hike might be delayed.
What do you think about the BOJ's monetary policy at the moment, and what are you expecting from them in the next several months?
Yeah, so we continue to expect the BOJ to hike in April, and followed by 2 more hikes in October and next April, taking the rates to 1.5%. And of course, there's the risk of delay in the BOJ hike, maybe towards say June or July. But I think, there's also a discussion about the effects, because if the BOJ does decide to delay effects, I think it does add another pressure on the effects side. Dalian could go even higher, and that could worsen the negative terms of trade shock, because, the multiply by the oil and higher Dalian. So I think the BOJ will continue to take relatively hawkish stance, as to avoid the excessive yen weakness.
What's fascinating is how different central banks are being treated in terms of their response to an oil price shock. In the ECB, yesterday, there were 2 rate hikes being priced in. The Bank of England, there was 1 rate hike potentially priced in at one point. It has faded. For the Bank of Japan, it was kind of the opposite. They said maybe they would delay it. Is there a feeling that the Bank of Japan's mandate is more on the growth side now and very much still not on inflation, even if those come into conflict?
Yeah, so I think, the BOJ is in a very different game in the sense that, yes, they're trying to contain inflation, but their bigger fear is to go back to deflation. So that's why they're only moving slowly to make sure that growth doesn't get hurt too much by, excessive rate hike or the oil price negative shocks. So they want to continue to be on the hiking path, but not to hurt the growth, that to avoid going back to deflation that we experienced over the last 30 years.
There was a period of time where we would talk about who's out there trading Japanese bonds. Oh, it's not one government guy sitting on a desk who owns all of them, and it's not actually trading. There were days when the Japanese bond market wouldn't trade at all. How much has the nature of who's involved in this market changed? And people actually coming back who are Japanese investors who now see value?
Yeah, so actually, you're right that the BOJ was the only trader in the market for a while. But now, actually, it's not so much the Japanese investors that's coming back in. It's actually the foreign international investors are actually coming back into the Japanese markets. And that's partly because, so for example, in the super long sector, life insurance companies are actually reducing the holding of JGB. That's partly due to, regulation, but also due to some demographics that demand for JGB is actually limited in the domestic market. But the international investors now see value in the JGB because it's, now more comparable to, say, European bond markets, so in terms of the yield and so forth. So it's actually the international community that's helped come back to JGB market rather than the domestics increasing the presence.
I remember those headlines crossing the Bloomberg terminal, the 10-year didn't trade today, which is kind of crazy, right? And we saw that quite a few times over a number of years.
It's what happens when you have 60% of the market locked up in the government balance sheet.
We've witnessed the enthusiasm for Japanese equities from various US-based investors around this table. It is the great repatriation trade that we're all thinking about, though, and Lisa gave a nod to it. Do you think the money eventually will come home, the money that has been invested in European fixed income into US equities back into Japan?
So I don't think there's going to be a major repatriation in the sense that their holding of the foreign bonds have also dropped in the recent years. So the largest sell-off of the foreign bonds by Japanese happened in 2020 to 2023 when the global duration was selling off and FX hedging costs were rising. So at that point, they already reduced the foreign bond holdings. And I think additional money will probably be invested more in Japan, but they're also waiting to see, how high the BOJ hikes, and because they don't want to be, basically picking up the falling knife at this moment.
Just a final question before you go. Obviously, the focus at the moment is on the Middle East and the supply of energy. As we started the conversation, Japan massively exposed, and Asian refiners across the board, India, Japan and elsewhere, exposed as well. How much of a cushion do those refiners have right now? What's your read on the availability of energy at the moment?
Yeah, so Japan has this oil reserve, which is worth about 250 days of the supplies in the daily consumption in Japan. So it could actually withstand a very long period compared to other countries. But of course, that's a quantity issue, but there's also a price issue, which, Japan faces the higher oil prices, that's multiplied by the yen depreciation as well. And also LNG import prices often linked to oil prices as well, so that also gets hit. So there could be quite a bit of a price shock on the economy, which, if extended, could be a negative factor for the Japanese growth outlook.
Shin, it's good to see you. Thanks for being here. Thanks for dropping by.
Thank you.
Thank you, sir. Shin Kadota there of Barclays, weighing in on the latest in Japan, fixed income and global markets. That's a massive buffer right there. But it's come at a pretty difficult time for a new Prime Minister who's got a vision of where she wants to take things.
Yeah, a little bit more stimulus, a little bit greater degree of fighting disinflation rather than concerned about inflation. The reason why this is so fascinating is because where the 30-year Japanese bond yield goes, so too goes the global bond market. That is the belief. So to the degree that they have a different policy than, say, the ECB in terms of their target, it has ramifications for the entire world.
As you suggested, there was a moment where we couldn't even really call it a market.
Yeah.
Because it wasn't much of a market. You need someone to buy and sell. to have a market.
Yeah,
and there wasn't much of one for quite a while.
Yeah, it was controlled pretty heavily. And there still is the glut of debt. And that's a real question here. And that's clearly what this administration is dealing with.
Crude this morning down 7%, about 92 on Brent. Up next, we'll catch up with Dan Greenhaus of Solus, Marc, the former chief of staff to the former Vice President Mike Pence, David Tinsley of Bank of America, Kathy Jones of Charles Schwab.
The surprise is that inflation is moving in the opposite direction.
Nothing good comes out of spiking oil prices this high.
The Fed is going to be very, very focused on what happens on the inflation side.
The big piece of this is how long this energy shock lasts.
I do think it's fair for people to take cuts off the table.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Futures just about positive on the S&P, attempting to build on yesterday's bounce, up by 0.2 on the S&P 500, on the Nasdaq, up by a third. In the commodity market, deep breath. The last 24 hours has been absolutely exhausting for anyone trading this stuff. 119.50 at the high, in the 80s at the low. Brent crude this morning, 91.90.
Yeah, a record move yesterday in the intraday price action. And what Stephen Schork said is he's never seen anything like this. Other traders have said things like, this isn't just volatility, but a sense of helplessness, because ultimately it's not being dictated by fundamentals. It's being dictated by comments that can change at any moment.
The hostilities continue. We've seen that a million times. There is no sign of a diplomatic off-ramp, and the production cuts keep coming. They keep adding up. The UAE, Saudi Arabia, Kuwait, Iraq, we're talking about almost 7 million barrels of oil a day taken out of production in that region. That's going to have its own impact.
Yeah, it's about 6% of global supply. Together, those four nations produce about 19 to 20 million barrels per day, which accounts for about a fifth of the global supply. So if you think about what this means, it is a massive resource for the entire world, particularly with respect to Asia, which is the reason why people are gaming out which regions are going to get hit hardest and how much dispersion is there going to be.
We keep going back to this quote from Amin Nasser of Saudi Aramco, typically quite a reserved, conservative kind of guy, saying this overnight. This one by far is the biggest crisis the region's oil and gas industry has ever faced, calling it catastrophic. Jemana Pasechi out of Dubai, leading our coverage out of the region over the last week or so, making the same point, that the way they're talking about what's happening on the ground with energy right now is very different to the hopium that came out of the administration just yesterday.
This is the 1-2 punch of both these shipments being prevented from going through the Strait of Hormuz, but also production being taken offline because of some of the storage facilities being filled up, but also because of refineries that have been taken offline in the region as a result of attacks. This is a toxic brew, if you will, of different events that has led to a lot of pessimism among the oil producers.
91.90 right now, Brent. We're down by 7%, and as you know, things can change very, very quickly. Coming up this hour, Dan Greenhaus of Solus Alternative Asset Management as crude prices whipsaw. The former chief of staff to the former VP Pence, Marc, as the White House signals a potential end to the war. And Kathy Jones of Schwab as bond market pressure continues to ease. We begin this hour with stocks pushing higher as crude pulls back. Dan Greenhaus of Solus Alternative Asset Management writing, if oil interference persists, the S&P 500 will probably be down 10%. Dan joins us now for more. Dan, good morning.
Thank you, sir. Good morning.
You're not typically the kind of guy that gets concerned easily. Are you concerned?
Yeah, I mean, I haven't been on in a little while, but last time I was on, we were talking about the weakness in the job market being something that was concerning to me. Obviously, there has not been any steep drop-off, but in the last jobs report, the private sector lost 86,000 jobs, which was, outside of COVID, the largest single job month loss since the GFC, basically. Now, obviously, some of that was skewed by the nurses' strike, and so we have to take it with a little bit of grain of salt, but clearly the job market slowdown has continued at best. I mean, it's probably not getting worse, but it's certainly not getting better. And so the backdrop coming into what's going on is an economy that's doing okay, but we're not creating a lot of jobs, which ultimately is the point of growth. Now you layer on top of that, obviously, the private credit software related issues, which I don't think is, I don't know how many people are arguing that it's systemic per se. I don't think it is, but it is certainly affecting a corner of the market. The financials are down this year, led by the Ares and the Carlyles of the world. And that raises concerns about the prospect for additional lending going forward and how much growth that has spurred over the last couple of years. And now you have what potentially could be an oil price shock. So getting back to your question, am I concerned? yeah, the backdrop's not great, and an oil price spike is never a good thing. But as a lot of people, I'm sure, are noting, it's not necessarily about the peak per se, so much as it is about how long this lasts. And right now, I'm not too concerned if we end this pretty quickly. Again, as you noted, oil prices are down considerably. If you can get them back down into the 80s even, let alone the 70s, then I think some of the worst case prognostications are going to prove to be incorrect.
Who is we when you say if we can end this pretty quickly? Who are we talking about?
No, I was going to make I was going to make a bad joke. But no, people in the financial markets that I talk to, I think are obviously acutely concerned about this. And when I say we, I mean the people that I talk to that represent the investor class, if you will.
Well, I'm talking about when you say if we end this pretty fast, are we talking about the president ending this pretty fast in the Middle East? Are we talking about the Iranians getting on board and ending this pretty fast in the Middle East? Are we talking about the Israelis?
Yeah, it's everybody, of course. I mean, listen, we know the president yesterday said this is going to be over soon enough. As we were talking about before we came on air, the Iranians have a vote in this, and certainly to the extent that they don't want it to end, they can continue with the drone program, for instance. But from a market standpoint, I think I was just saying, so on the political side of things, there's this conversation about why are we there, the shifting rationales. And that's a perfectly fair political conversation to have. But from a market standpoint, whether it's missile capacity or nuclear capacity or the regime itself, the president and the Americans have a number of off-ramps to say, to declare victory, so to speak, and call it a day. Now, again, the Iranians have a vote in this, but from a market standpoint, that's a number of different positive outcomes in terms of this being, quote unquote, over.
Which is the reason why, for the most part, markets are trading as though this is going to be limited in time. And frankly, Jason Thomas of Carlyle just put out a note saying the risk is time. Right now, people are assessing that risk is contained. Has there been anything that has shifted based on the non-farm payrolls report, plus the fact that oil prices are probably going to be somewhat higher, at least in the next 3 months, as a result of this?
Yeah, I think we should certainly get comfortable with the idea that oil prices will be higher. And this is something that we've talked about for a while. A number of times I've come on here, I've noted we've been interested in the energy space and invested in the energy space, partially on the idea that the long-standing geopolitical risk premium has effectively ground to zero. That's now, presumably for the immediate future, not going to be zero anymore. So are we going back to oil in the potentially 50s? I mean, coming into this was the oversupply issue. We're working through that very, very quickly. We're probably talking about a more normalized environment, excuse me, in the 60s or 70s. However, to shift back into the political realm for a second, 5 years from now, 7 years from now, 10 years from now, perhaps the geopolitical risk premium should be flat or negative on the idea that, well, now, in the best case scenario, you've got a more accommodative Iranian regime. The Lebanese are now reaching out to the Israelis. You've got the Abraham Accords. Perhaps this is step, 1, 2, or 3 in terms of reshaping the region and creating an environment where geopolitics is perhaps less of a concern. Maybe that's a little Pollyannish, but that is one possible longer-term outcome.
These soothing headlines keep coming. The president has done a series of interviews with a range of media outlets in the last few days. This one is with Fox News, releasing this comment right here, that the president says it's possible to speak to the Iranians. Off the back of that headline, crude rolling over just a touch. We're now down by more than 8% on Brent to $90 and about 70 cents. More the same from the president.
Yeah, communication, and it's the signal, perhaps more than the details, since we don't really have a lot of details, but the signal is there is a desire to talk. There is a desire to find that off-ramp, which is the reason why people are leaning to the idea that it will be contained. What is the new normal once this is contained? And I think that you've got both what Dan was talking about in terms of the really bullish scenario for oil prices coming down and a more greater and durable piece. And then you have a more negative idea with a more protractive, higher oil price.
Dan, what is the price of the volatility, given the fragile backdrop that you described at the start of this conversation?
Well, I mean, you see it in the VIX, in the VVIX, in the OVX. I mean, volatility is up everywhere, and deservedly so. I would just, to dodge that question for a second and go back to what you just said about the president talk. We shouldn't be surprised. I mean, this is a guy who flew to North Korea and was willing to talk to the North Korean president, something that the entire political class thought was nothing short of insane. So, and he's said repeatedly that he doesn't, I know some people will find this offensive, so to speak, to say, but this is a guy who's repeatedly said he doesn't want to go to war. He doesn't want to have war. So I entirely am not surprised by the idea that he would talk to the Iranians.
So let's say there is an off-ramp, and let's say it is contained the next couple of weeks, right? And I understand that's a huge if. Has there been, just as sort of what people are trying to get to, Has this alone put a damper on the forward-looking growth trajectory, especially paired with non-farm payrolls? And we just got small business optimism that did fall below expectations earlier this morning. I mean, or are we looking at everything in a negative light right now simply because people are feeling jittery and will once again go back to potentially things surprising to the upside?
The first thing I would say is I think a lot of people have been looking at things in a negative light, not just right now, but for 20 years. We've talked about this in the past, that post-GFC...
Been scarred by it.
Yeah, everyone's trying to be Nouriel Roubini. I've made this comment a couple of times.
Who's, by the way, bullish right now, but carry on.
Fine.
Yes.
Pre right now. So yeah, I think there's a lot of pessimism. However, again, getting back to the peak versus the duration conversation, if oil prices come back down, and this is wrapped up in a week or two, and we get ships going back through the Strait of Hormuz, et cetera, then I don't think there's going to be too much lasting damage or scarring, so to speak, in the economy. Obviously, there'll be some short-term issues. Gasoline prices at the pump, which is ultimately what matters for consumers, are already higher. I have friends talking about seeing $4 gasoline. But that will pass quickly if we start getting oil back. And eventually we will return somewhat closer to the oversupply story, the 2 million barrel oversupply story that persisted before this moment. I don't know how quickly we're going to get there, but again, oil price spikes tend to be temporary in nature. That's why we call them spikes instead of oil price plateaus.
How much have you been getting involved then as a result of this, if you actually do see a more positive outcome and you see price dislocations?
Well, listen, we're all, to repeat, we've been in energy for a little bit of time now, so this is all working to our benefit. I don't know if I'm allowed to say this, and my compliance department will have talking to when I get back. But so this is to anyone who's exposed to energy, we'll say that.
Well done.
Is obviously benefiting positively. And for those people, the question becomes, do you lighten up into this? And if so, do you rotate? I mean, one thing I was talking to somebody last night about is if you've been in energy, as some are, maybe you want to rotate out of energy, take some profits off the table, and go into something like the airlines that have been disproportionately hurt by this, or perhaps the cruise lines, because we can pretty much model out, obviously, the fuel costs for both of those industries. And if oil goes back down and jet fuel falls and cruises see a benefit, you might see a pop in those names on the other side of this. So there are things to do around this if you believe, as I do, that the economy is not, in the short term, going to be meaningfully impacted.
Well, it's the consumer piece of this that interests me. If we put it together, everything you've been talking about, the labour market is somewhat fragile. I don't think it's stable. I think it looks fragile. The financial conditions have been tightening. You can see that across the market. And then you layer this on top at a time we're about to get tax refunds. I don't think the average consumer, the consumer with a higher marginal propensity to spend right now, is going to take that tax refund after seeing these headlines and book the cruise or book the flight.
Well, and that's why it's important to get a headline on Sunday that said, victory declared, war over. In which case, we already have seen tax returns are up, call it 10% year over year. A couple bucks in people's pocket. That's very helpful. Obviously, gasoline's increase will eat into that somewhat. But the larger benefit from the no tax on tips, et cetera, really over time more than tips, is going to be beneficial to the economy. The consumer already, we know, in the United States is disproportionately inclined to consume. And they're going to start seeing some larger tax breaks. And that's going to be a positive going forward. I would just say the labor market has been fragile, so to speak, for some time now. And while I mentioned earlier the drop in private payroll growth, although, again, partially related to the strike, I haven't seen it get worse. Yeah, the unemployment rate's been drifting up, although there's some nuance to that, but I haven't seen it get worse. And so to the extent that it doesn't get worse, and we're just in this low growth no hiring, no firing?
Low hire, low fire.
I don't know.
Same thing.
LFLH, very close to LFLO from the 2000s for the Gen X and millennials out there. As long as it's not getting worse, then I'm okay. And it's important, again, the core right now, to the earlier comment, fundamentals don't matter. Let's get oil prices back down, and then we can all take a breath.
They're down this morning. They're down by about 7 to 8% at $91 a barrel on Brent. Dan, it's good to see you. Thank you, sir.
My pleasure, sir.
Thank you. Dan Greenhaus there of Solus Alternative Asset Management. Up next on the programme, betting on a short war.
We took a little excursion because we felt we had to do that to get rid of some evil. And I think you'll see it's going to be a short-term excursion.
Are you thinking this week it will be over?
No,
Are you talking
but soon.
about days?
I think so.
Up next, Marc, the former Chief of Staff to the former VP Pence from New York City this morning. Good morning. Live from New York City, welcome to the program. Equities just about turning negative just moments ago on the S&P 500, unchanged now on the S&P. On the Nasdaq 100, positive by close to 0.1%. The small caps, the Russell, negative by a third still, even as we pair some of the big gains we've seen in crude more recently. Brent is down by close to 8%, 91.20. WTI 87.90. The president speaking to Fox News a little bit earlier. They released some of those comments, open to speaking to the Iranians. More soothing headlines over the past few days.
Indicating a willingness to find an off-ramp at a time where it's not exactly something that he wants to see in terms of oil prices rising to this degree. You've raised the question multiple times. How much agency does he have to unilaterally end this conflict? And I think that's a question that we should give some more time to.
It's something I'm slightly uncomfortable with right now. The amount of people we're speaking to that are comfortable that the president has the ability to end this whenever he wants. This is not Liberation Day. This is not tariffs on, tariffs off. You've opened up something else now in Iran. And it's not clear to people who's actually running the show in Iran. Particularly the major contradiction over the weekend when the president comes out and apologizes to Gulf partners, Gulf neighbors. And then the strikes continue because he's not really running the country at the moment.
Yeah, there are a lot of questions also about Israel's goals because Israel is also involved in this, and it doesn't seem like they're entirely aligned with U.S. goals. It also is a question about some of the Middle Eastern neighbors that are experiencing these missile incoming attacks and are going to respond. So there are a lot of questions as this does widen its umbrella.
Under surveillance this morning, betting on a short war.
We took a little excursion because we felt we had to do that to get rid of some evil. And I think you'll see it's going to be a short-term excursion. We're winning very decisively. We're way ahead of schedule.
Are you thinking this week it will be over?
No,
Are you talking
but soon.
about days?
I think so. We could call it a tremendous success right now as we leave here.
Here's the latest this morning. Crude prices pulling back as President Trump signals an early end to the Iran war, calling military objectives, quote, pretty well complete. Bloomberg's Tyler Kendall joins us now for more. Good morning, Tyler.
Hey, John, good morning. Well, President Trump maintains that the U.S. is ahead of schedule in achieving its military objectives, but that he doesn't think that the conflict will resolve this week. In fact, he says that the military operation will not resolve until he is satisfied that Iran's nuclear program will not be able to be obtained. Now, you mentioned we got new comments this morning with the president speaking to Fox News saying that he would be willing to speak to the Iranians, but then added that he, quote, sort of doesn't need to speak to them anymore. Pair that with comments that we got earlier this morning from Iran's parliament speaker saying that the country is, quote, absolutely not seeking a ceasefire, and a statement overnight from the IRGC maintaining that it will block oil exports from the region. Yesterday, President Trump threatened to widen the list of U.S. targets to electricity infrastructure if disruptions continue in the Strait of Hormuz. He reiterated that the U.S. Navy stands prepared to escort tankers through that critical waterway, which at the moment remains effectively shut. As Bloomberg News reports this morning, it appears electronic warfare is jamming signals in the Straits. Now, President Trump has said that there could be a few options on the table when it comes to curbing high prices. We heard him yesterday mention the idea of waiving certain oil-related sanctions, though he didn't specify that beyond saying he spoke with Russian President Vladimir Putin about it yesterday. John, people familiar with the matter tell us that the administration has been looking at several options, including a federal gas tax holiday, which would require congressional approval, or tapping strategic reserves amid questions about replenishing the SPR. I will quickly leave you with one domestic angle to this. New polling out from Ipsos this morning finds that 67% of U.S. adults are concerned that gas prices are going to get worse in the year ahead.
That is not surprising, Tyler. Thank you, Tyler Kendall, down in Washington. The signal from the president is important. So is the reality on the ground. Just as we're speaking, these headlines crossing, the UAE says it's currently responding to a missile threat. Qatar saying they intercepted a missile targeting the state of Qatar. And we've seen headline after headline like that and more still to come.
Yeah, and the IRCG coming out and saying this war isn't over until we say it's over, even though the president is saying, I can stop this at any point.
Joining us now to discuss is Marc, the former chief of staff to the former vice president, Mike Pence. Marc, good to see you.
Great to be here. Thank you.
This is not in the president's traditional playbook. This feels so different. Typically, he has something targeted, it's limited, it leads to a period of de-escalation. This feels so open-ended. How would you characterize what's evolving in the Middle East?
Well, I think there's some truth to that obviously, Venezuela, he wasn't looking for regime change. He left Maduro's number 2 in place. But at the same time, I think the president always likes optionality, which I think you've witnessed over the last 10 days, is that explanations as to how long this is going to be continue to vary a lot. And so I think you'll continue to see him want to keep that optionality as to whether he continues to prosecute this war or pull back.
How different is this time in terms of the support from other Republicans in Congress for the effort? I mean, it was sort of pretty unified around Venezuela. Is it the same here?
Well, I think that there's obviously been a growing threat of isolation inside the Republican Party. I think it's been notable that J.D. Vance has been pretty quiet and not as visible as far as advocating for these policies. And I don't think there was as much of an effort ahead of time to explain to the American people the priority and why we're doing this, which is why I think you see the polling down. Having said that, Lisa, if the president's successful here, and in many cases this military operation has been successful, but if he also is able to transform the Middle East for generations to come, I think you'll see a lot of Republicans be on board with this. I think the greater political concern in the short term is that affordability remains the #1 issue for Americans. And I think that even if best case scenario oil prices, now are in the $80 to $90 range a barrel, that's still a 33% premium over what they were. That's not going to help with the affordability issue heading into the midterms in November.
So what do you think is the most feasible counteraction to that by the president heading into the midterms?
I think the most feasible is to continue to explain why this is a necessary action, why for 47 years Iran has been at war with the West, why they've, going back to funding the Hamas and the Hezbollah and the Houthis, why they've killed Americans in Western Sahara, why we did this. I think that's what he can do best. As far as triggers, I think that one thing that would be helpful is if you relieve the Jones Act. But I think there's a lot of tension inside the administration because you have the protectionists and the Peter Navarros for whom that is sacrosanct. They don't want to see that. I think it's disappointing to see actually providing relief for Russian oil at this point. I think that Russia's been partnering with Iran for quite some time. Iran's been funding and been providing them drones in their war in Ukraine, and our recourse to this is to actually relax the oil sanctions on Russia. I think shows the sensitivity they have politically to rising oil prices.
There's something very backwards about the whole thing. We're now asking help from the Ukrainians to help us intercept drones. At the same time, we're offering sanctions relief to the Russians who they're fighting with at the moment. Make sense of all of that.
No, thank you. I mean, that's basically, I mean, ultimately, you're sort of putting your thumb on the scale on both sides. Anyone who's saying this is going to create a sooner resolution to the Ukraine-Russia war, please explain to me exactly how.
I could just beg the question how prepared they were for this. Why the Chinese were able to stockpile energy over the last 12 months and America didn't refill the SPR.
Well, look, I mean, I think that there was a lot of depletion of the Strategic Petroleum Reserve during the Biden administration.
Massive depletion, without a doubt.
And I think there were opportunities to continue to replenish it. I do think that there's obviously more oil production out of the United States today. And I think that the president deserves credit for having lowered energy prices as significantly as he did. But as we've talked about on your show, I think that the reduction in energy prices in many cases was masking the trade agenda and the extra costs. If all of a sudden you've taken that relief off the table, I think you're going to see the trade agenda, inflation, come to the voters even more sensitively.
How much control do you think he has over the fate of what's developing before our eyes?
Look, I think he has more control than anybody else. But as you said, I don't think he has total control over this. And you're saying, I mean, Qatar's still saying $150 before this is all said and done. They have facilities that are still offline. Bahrain has facilities offline. And so it seems to me there's a heck of a lot more volatility here. And it's just because the president signaled maybe this will be a shorter term conflict. Doesn't mean that that's guaranteed.
Marc, it's good to see you.
Great to see you guys.
Thank you, buddy. Thank you. Marc Schork there, the former Chief of Staff to the former Vice President Mike Pence. Successive presidencies have had reasons to do what the president is doing right now. But there is a reason why they didn't take the playbook off the shelf. Because it can get messy very easily.
Yeah, in the Middle East, things are not typically clean, and we've seen that time and time again. There is a rationale for this and a potential best-case scenario that's really good, and I don't think that we should lose sight of that. The problem is the path there is so messy and uncertain and bringing in so many variables and changing on a dime, which is leaving people wondering, what is the playbook now, given that, as President Trump said himself, some of the people he was thinking about to lead Iran are no longer in existence. So how do you proceed with a path forward?
What happened to all the headlines, the stories, the policy effort around affordability? And then this, very quickly, the message gets murky. Now, if you come out the other side with more production, maybe you've got a better story to tell. But the runway, we've talked about the amount of time until the midterms. That runway is getting shorter and shorter as the months pass by. Up next on the programme, David Tinsley of Bank of America Institute as the conflict in Iran hits the US consumer. Interesting setup this morning. You've got crude declining and the equity rally stalling. Check it out. Crude's down by about 8% at the moment. We're down by 8%, say, on Brent, and on WTI at the moment down by 7. 88 on WTI, 91 on Brent. That's the picture of crude. As the president, speaking to Fox News, says he's willing to speak to the Iranians as the strikes continue, makes sense of that. But once again, the difference between the signal and the facts on the ground. And then the equity market rally just rolling over. No positive follow-through here off the vicious bounce from Monday's low in that trading session. We're just about unchanged on the S&P. On the Nasdaq, just about positive by 1/10%.
Yeah, and ultimately, at a certain point, are we seeing enough calm or some of the stock traders can take a step back and say, why would I be incredibly invested in an incredibly volatile time, number one? Number two, what has changed, even if there is some sort of pause to this? Well, it's going to be higher oil prices, and it's going to be consumer that is still crimped, and possibly a Federal Reserve and other central banks that will refrain from cutting rates anytime soon. And it is a landscape potentially to crimp growth.
It's a triple threat. You've got a labour market that's fragile, an economic backdrop that's not convincing but has the potential to improve with all the stimulus behind it. Then you've got the tightening of financial conditions layered on top of that, and the energy shock that's exacerbating the problems for both the first point and the second point. Put that all together, it's not a great picture right now for risk assets, even if you believe the president's in a position to back away.
Even if he backs away, there are these production cuts that have already gone into place that will take potentially weeks to really work through.
Brent crude this morning down by close to 8%, 91.40 as we count you down to the open, about 2 hours away with your morning movers. Danny has more. Hey, Danny.
Hey, John, looking at some of the stocks that are specifically moving on that oil move and did yesterday, too. Oxy, Chevron, Devron, again, all of these turned around yesterday with the news coming from the president about a possible short-lived nature to this excursion, as he called it. Now, for the past week, Oxy is the only one of these stocks that's positive, and it's only positive by 1.5%. So today's move should erase that gain so far since the war broke out. On the flip side of things, you have the beaten up stocks, and that were the airlines, the cruise ships, because of higher oil prices, higher fuel, and maybe concerns about sentiment. So these stocks turned it around yesterday. They are getting a slight pop, but John, much like the overall market, some of that convincingness of the gains of this morning is starting to wane, but they're up at least 0.5% in the case of Delta. Finally, some earnings news coming from Kohl's, and a big disappointment. Comparable sales fell 2.8%. It has been years of declining sales for Kohl's. They can't turn it around. They have a new CEO. That not helping them out. Shares dropping 7.4%, saying that the competition was tough for Black Friday. You're also seeing Macy's shares fall in sympathy this morning too, John.
Hey, Danny, thanks for the update. More from Danny in the next hour. Kohl's problem or consumer problem? We often play that game with the retailers.
So I'm trying to figure out what their commentary was, and they really came in incredibly weak on fourth quarter earnings. It's being treated as a consumer problem, which gives you a sense, I mean, ultimately I can't answer, right? But which gives you a sense of how the market's treating it, which is this is a broader issue, not just a Kohl's issue.
That's usually how the retailer wants to describe it in a moment like this, right?
Exactly. You know, our turnaround's on track. That's the commentary, and people are saying, okay, maybe.
It's never about execution.
Well, and people are sort of looking at them and saying, let's see.
It's a choiceful consumer, as they enjoy saying. On a radar this morning, crude prices easing as President Donald Trump signals the conflict in Iran is nearing an end.
On Iran, you called it an excursion. You said it would be over soon. Are you thinking this week it will be over?
No,
Are you talking
but soon.
about days?
I think soon.
Okay, and with respect
Very
to...
soon. Look, everything they have is gone, including their leadership. In fact, there are two levels of leadership, and even actually, as it turns out, more than that. But two levels of leadership are gone.
The president saying the Navy will escort tankers through the Strait of Hormuz. Elsewhere, Gulf oil giants deepening production cuts as the Strait of Hormuz remains all but shut down. Saudi Arabia, Iraq, Kuwait and the UAE cutting output by nearly 7 million barrels a day, amounting to 6% of global supply. And finally, the White House weighing several options to curb rising gas prices, including the release of emergency stockpiles and halting collection of the federal gas tax. The president saying he has a plan to address energy costs without providing the details.
And one person after another has come in and explained the limitations of each of these various proposals. Marc Short was just saying the most likely one would be relieving gas taxes and potentially ships that are built from foreign ships in U.S. harbors, which I believe is something covered by the Jones Act. But there is internal pushback because it sort of pushes against some of the nationalistic efforts by this administration. It is policy in conflict right now on a whole multiple slew of levels.
G7 finance minister surprised me yesterday. It felt like we were drifting towards release of emergency reserves, and somehow they backed away and said they weren't there yet.
Well, they're still talking, so there's still time.
Wouldn't it make sense to? Isn't that what they're there for?
You know, if they think that this is going to be short-lived, and I'd actually be very curious to see what the rhetoric is coming out of there, why would they use their resources now, given the fact that supply shocks have happened again and again and again? So what is President Trump, what is the U.S. administration telling them about the timeline? I know this feels a little bit like reading tea leaves and tarot cards, but that's where we're at.
If the president and the White House is relieving sanctions on Russian crude, I think that tells you that they're not in a good spot right now. No? Isn't that the obvious signal from that? If you're compromising your foreign policy objectives elsewhere, then things aren't going well, are they?
Well, I think a lot of people would agree with that.
Let's turn to the consumer. Feeling the pain at the pump, the average price for a gallon of gasoline jumping more than 50 cents since the war broke out. The Bank of America Institute reporting recent rises in the international price of oil and the knock-on effect on gasoline prices may put some upward pressure on household spending. David Tinsley of the Bank of America Institute joins us now for more. David, thank you. Enjoyed the read once again. The difference between now and 22. It appears to be many things, but including the household balance sheet and incomes. How much can this consumer offset? How much of a cushion is there to insulate themselves from this energy price shock?
Hi, John. Yeah, so I'm joining you actually from B of A's Consumer and Retail Conference in Miami. So all of this is, real top of mind stuff down here. What we see in our data is a very robust spending picture as of February. January, February together. The weather was messing around a little bit with the January data. But really, to your question about balance sheets, in our report today, we're pointing out a couple of things, really. One is that consumers have some space to borrow. When you look at the proportion of our customers that pay off their full credit card balance every month, it's actually higher than it was in 2019. So some people can borrow more. There's dry powder, if you like. And the good news really is that the refund checks from the stimulus are hitting people's bank accounts right now. Now, a few weeks ago, that probably would have been spent either saved or spent on discretionary goods, of course. Right now, maybe a little bit more of it will end up being spent on necessity goods, gasoline, for example.
David, have you got a read on the spending right now? What's the early read on where the money's going? Is that where it's heading?
For the tax refunds, what we're seeing right now, and it's really early days, so it's interesting actually that higher income households are getting bigger refund checks. They're up over 10%, up more than for lower income households and middle income households. But because lower and middle income households are under the pressure, they're spending more out of those refund checks. And so when we look at, for example, discretionary spending, 3 weeks before, 3 weeks after a refund check, lower income households, their spending's up about 20% plus, and it's less than that for the whole sample. So I think, it's a slight mixed bag. Early days, like I say, perhaps it'll end up more being skewed towards these affordability issues. But at the moment, it is being partly spent and partly paid. Debt's also being paid down on using the money, I think.
David, we've seen different retailers report very different results depending on which part of the K they cater to, whether it's very wealthy individuals or whether it's middle and lower class, lower income individuals. I'm just wondering, from your perspective, do you see that K widening or coming together?
Well, in the very latest data, there's a small narrowing in the K between higher income households and lower income households. But I wouldn't make great play of that. I think it's the lowest it's been in our data for about 6 months, but it's still very wide. But I think last month we were talking about the middle income households and how increasingly it looks like there's a K opening up between higher income households and middle income households. And that's still very clear in our data. And just one other point, all of this is underpinned by wage dynamics. Higher income households in our data, their wages are growing at over 4%. For lower income and middle income households, their wage growth is moving lower. And so the gaps between higher and middle and lower income households, they're the widest in our data for wages that they've been for 10 years. So even though this tax refund story can kind of shift the data around over the next 6 months, when we come back to what's going to drive the consumer in the second half of this year, it's going to be wages. And that supports continuation of the K, I think.
Does it support continuation of strength in the economy, or does it point to a very different backdrop with less consumer resilience?
Yeah, that's a good question. So, I mean, higher income households, they really punch above their weight in terms of overall consumption. And the growth in that cohort's pretty steady. So I think going into the second half, as long as those guys are still spending and still increasing their spending, the overall consumer picture can look quite healthy. Now, middle and lower, clearly a concern, particularly middle if it continues to cool. So, we might come off a frothy period, partly related to tax refunds, but I think there should still be some momentum behind the consumer in the second half.
David, we hope you're right. It's good to see you, as always. David Tinsley there of the Bank of America Institute. Tax refunds should help cushion this economy, but that was the bull case. And now it's like the as you were case. And that's a problem. And that's why the oil move is a shocker. You wanted these guys to go out and spend this money on discretionary goods and help fuel a bounce in the US economy. And now we're talking about the money going to necessities and the spread between high income and middle income getting wider and not narrower. All of that is adding up to a very different view of the future than where we were even just a month ago.
If people are looking for a sugar high from these tax refunds, that sugar high, to your point, is probably going to staples, not necessarily discretionary goods. I'm just thinking about the fact that the wage growth gap between higher income and lower income families is the widest that it has been since 2015. This really speaks to a question of at what point that gets rectified by some overarching economic trend, or whether this just gets expressed in the political venue, which is the reason why affordability is increasingly on the agenda time and time again.
A massive midterm issue. Equities, by the way, down by about 0.1% on the S&P 500 at the moment. In the commodity market, crude still negative by 7 to 8%. We're down to 91.20 on Brent crude, following a wild ride in the last 24 hours. Still tracking the headlines coming out of the Middle East. This, a report just moments ago, Iran beginning a new wave of missile strikes on northern Israel. There is little sign of de-escalation this morning on the ground, even if you're seeing signs of the president trying to put together an off-ramp for the crude market.
Yeah, and Iran has come out and said, we're not done with this. I mean, they've said this repeatedly at the same time that they elected someone, or they chose someone to be the next supreme leader who is a continuation play of the prior leader. So a real question here about what the off-ramp is for Iran, especially with the enriched uranium still on the table and questions about a land operation to go get it. So still a lot of questions around the story.
Up next on the program, protecting the flow of energy.
We're also focused on keeping energy and oil flowing to the world. And I will not allow a terrorist regime to stop the globe's oil supply. They better not play that game.
Up next, Kathy Jones of Charles Schwab, live from New York City. You're watching Bloomberg TV. So we've got some things to get through. Let's start with this. The day ahead is shaping up as follows. In the next hour, you will get a briefing from the Pentagon. The Defense Secretary, Pete Hegseth, will be speaking. That's about 15 minutes away. In the next hour or so, we should get another call, this time from G7 energy ministers, with a release of reserves very much on the table. So look out for that. After the close, we talk about tech Oracle earnings coming up after the closing bell, as this headline crosses right here just moments ago, that Amazon is kicking off an 11-part US investment grade debt offering. We've seen this from a number of tech companies, including Alphabet, which offered a lot of debt across a lot of maturities and a lot of denominations, and a lot of demand came in. This feels like a different moment to issue some of this debt.
We've already seen a number of issuances pulled, more from the high yield side than the investment grade side. You have seen spreads widen out. Will there be the same demand? Because all of a sudden, this is the new haven, right? I mean, this could go one of two ways. We could see either people push back, concerned about the risk, or suddenly all the fears about AI have gone away. And now that's the ballast of any economic trajectory going forward. And people are going to want to buy it. It'll be a great barometer of sentiment.
It's an interesting test. So look out for further headlines on how that deal is going. Equity futures pulling back by some 0.2% on the S&P 500 as those headlines cross. A quick sneak peek at the price action across the Nasdaq, the Russell, the S&P 500. It's shaping up as follows right now. On the Nasdaq, we're down by about 0.1, so that rolls over, and the Russell's down by about 0.5. Even with this move in the commodity market, crude's still lower by more than 7%, 91.40. WTI at about 88. We're down 6% on the session there.
You had the NFIB small business optimism come in a little bit below expectations. You've just seen on the margins some of the economic data come in below expectations following what we saw with non-farm payrolls. This all adds to the feeling that maybe you can't get a Fed that's going to be easing quite as quickly. And either way, people are reassessing whether that should shift some of the risk appetite.
Payrolls was a shocker. Hardly talked about it.
Hardly talked.
We've had more redemption requests and certain credit companies, certain private credit firms struggling to meet them. Shocker, hardly talking about it. Because at the moment we're only talking about one thing, the energy shock. But the energy shock contributes to all of those things in negative ways. And that's the problem about this moment.
And even if you do end the conflict on some level, people are saying that the oil price will be reset at a higher premium and already has been. So that has to be factored in.
Under surveillance this morning, protecting the flow of energy.
We're also focused on keeping energy and oil flowing to the world. And I will not allow a terrorist regime to stop the globe's oil supply. They better not play that game. In the long run, oil supplies will be dramatically more secure without the threat of Iranian ships, drones, missiles, nuclear menace, or anything. So the Strait of Hormuz is going to remain safe.
So here's the latest this morning. Treasury yields reversing course as the president looks to calm oil markets. Kathy Jones of Charles Schwab writing this: if crude prices go up to 120 to 150 a barrel, then overall inflation could rise by 50 basis points or more. Kathy joins us now for more. Kathy, good morning. Good to see you.
Good morning.
What if we stay in the 90s, in the 80s? How much does that change the outlook for you and the team?
Not too much. I mean, I think one scenario, and the scenario that the market has favored, is this is a short-term shock. It will pass as others have passed. The Fed will look through the price implications, and, you know, we'll go back to normal, whatever normal is after this. But that risk appetite will come back, and Fed will be on hold for a while, and, you know, possibly cut in the second half of the year. But I think what's interesting is the cross-asset correlations that we're seeing, or the unwinding of some of those. So as crude went up, yields went up. And it shows you that the market is very attuned to the inflation end of things and not to the demand destruction that's possible. That might reverse if prices continue to go up, even if inflation is going up. It may be that the market starts to focus on the recession risk and not the inflation risk.
This is the tipping point I think we're all interested in. Where is that tipping point where this actually becomes bond bullish and not bond bearish?
Yeah, I think it's hard to say, but it's where we see the potential for recession, right? At what point does the damage to the global economy and to the domestic economy, which has been pretty resilient, but at what point is that so much that we worry about recession, employment, et cetera? And, you know, if a sustained move to 120 and above, I think the market starts to price that in.
I've read a number of notes saying that on the margins, the chance of recession, which had been completely off the table earlier this year, has gone up just by virtue of a stagflationary shock. Do you think that that's accurately priced in the long end of the yield curve?
No, I think that if we were to actually get a recession, the long end would rally, that yields would come down further. The offset to that is we do have inflation and we do have rising deficits as far as the eye can see. And so how do you parse that out in the bond market? Higher term premium perhaps, but lower overall yields, because the Fed would probably be leaning towards a dovish stance.
I'm just wondering how much this curtails some of the other stories. As John was mentioning, we've been talking about credit shocks in the private markets. We've talked about concerns around software debt in particular. The leveraged loan space has gotten hit. I'm just wondering, if you have higher benchmark yields on the long end and you have risk aversion causing higher premia, at what point does this create fundamental stress in some of these corporate names that already are kind of on shaky ground?
Yeah, I would say in like the investment grade space, I don't think that they're really at risk in particular. Balance sheets are still pretty good. Management of the the interest rate risk is still very solid. It's when you go down the credit spectrum, and even high yield, which is less junky than it used to be, still the balance sheets are in pretty good shape if the economy is growing. It is in the leveraged loan market and in private credit, where you start to get concerned because that's where the underwriting standards are weaker, the companies are smaller, the credit quality is lower. And I think the fundamental risk there is what's the exit strategy, right? If the economy doesn't do well, what's the exit strategy for those companies? And if they run to the door, if their investors run to the door, that's when you create the stress in the market.
For the bigger companies, we've seen a lot of supply met by tremendous demand. We saw two headlines cross just moments ago. Lisa and I were talking about that. Amazon kicking off an 11-part US investment-grade debt offering. An additional headline mandating banks for an 8-part Eurobond offering in euros as well. Can you talk us through whether you think that demand is going to be a feature of this year, or is this just a moment that we're in? Or do you think that this supply, because it's going to keep on coming from these major players, that investors are willing to meet that with tremendous demand?
You know, I think the demand is there as long as the global economy holds up. But if I'm actually a little surprised at the timing of this offer because there's so much going on, but clearly they must have an indication that the demand is there and they can get this done at yields that are attractive to them. But I do think the longer this conflict goes on, the longer the risk is to the global economy, not just the U.S. economy, the harder it is going to be to absorb this without a wider spread.
Lisa, are you surprised?
Yeah, I am.
That they've come to market right now?
Well, I'm looking right now at the all-in yield for investment-grade bonds, and it's 4.9%. Plus or minus a couple basis points. That's actually where it's been since the end of December. So it actually hasn't moved all that much. My question is, are they trying to get in before they see even more stress? Do they see an opening for something in terms of people looking for haven trades, and suddenly AI, which was a pariah, is suddenly thought of as a bastion? So people don't have enough space in their heads to think about AI as the real risk. So maybe they're going to go into this head over heels. There are a lot of questions here. I do think that it will set the tone for AI issuance for the year ahead if they can get in, clear this at a time of a lot of potential volatility.
Do you remember the Greenland crisis? Do you remember that one?
Nope, don't remember it.
But what a strange
ridiculous.
year. And I know, look, I sound like a broken record, longest first quarter in the history of first quarters. But think about the different shocks that we've had to confront over the last 2 or 3 months.
When it is humdrum to say another record day on this, that, or the other, right, it gives you a sense of just how benumbed we have become to the incredible news flow.
There was the Greenland crisis that lasted a couple of days. We've had this, the energy shock, the AI disruption, a terrible payrolls report that hardly anyone is talking about because it's all been ignored given what's happening elsewhere, redemptions of private credit firms, and taking out Maduro in Caracas feels like child's play for financial markets at the moment.
The way that people talk about that is the clean one, the one that actually was executed cleanly without any consequences, even though there are some consequences which are continuing.
Kathy, good to see you. Thanks for being here.
Thank you.
As always, Kathy Jones there of Charles Schwab. On the headlines in the bond market at the moment, the notable one happening just moments ago, crossing the Bloomberg, that Amazon is kicking off an 11-part US investment-grade debt offering, in addition to that mandating banks as well for an 8-part bond offering in euros.
Yeah, and at a time when potentially people are worried about the ECB hiking rates. Maybe the Amazon is worried about the ECB hiking rates too, and they want to get in before that.
It's an odd moment, isn't it? It really is a strange moment. Up next, we'll catch up with Kevin Foley of JPMorgan, Tom Fitzgerald of TD Cowen, Abigail Watt of UBS, Jim Caron of Morgan Stanley. The third hour of Bloomberg Surveillance just around the corner.
There is spectacular amounts of volatility.
It feels like we should kind of sit on the sidelines for a moment here.
The market is looking for just what the off-ramp could be.
This doesn't feel like the beginning of a great year.
Eventually, that volatility will create great buying opportunities.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. And your scores, the price action looks like this. Just about avoiding a third day of losses on the S&P 500 yesterday with a major bounce off the low into the close. Futures right now negative again by 0.2%. No positive follow through here on the Nasdaq, just about rolling over, underperforming the Russell, negative 0.5. Following that wild ride in crude yesterday, 119.50 at the high, in the 80s at the low. We're down another 7% this morning. Brent at 91.94, WTI at 88. On the agenda, on the calendar later on this morning, moments away, there will be a briefing from the Pentagon. We'll track the headlines coming out of that and catch up with Tyler Kendall in just a moment. And later on this morning, there will be a meeting between energy ministers at the G7 level at a time when we've been waiting for some kind of reserve release from these countries.
Yeah, 1:45 p.m. local time in France. This meeting is taking place. Will they come to try to stave off some of the price increases that we've seen for consumers? Clearly, there is the will to do so. To answer your question, why haven't they done so far? And I think that's going to be a really key point today.
You look at the shape of the curve, it's an extreme backwardation right now. They could meet this, put out all that supply, issue those reserves, and then just buy further out along the curve, and that would make sense. I know things aren't as straightforward as that, but that would be the thinking, I think, at their level in this discussion.
Maybe. Let's hear what they have to say. Honestly, I've just been shocked by how idiosyncratic each type of oil is, where you're going to be getting it from, and how you can really do this in a way that effectively lowers prices for average consumers quickly. And I think that that's the challenge right now that they're trying to deal with.
There is nothing straightforward about any of this, and we've seen the cuts to output continue across the UAE, Kuwait, Iraq, Saudi Arabia, 6.7 million barrels a day now of output cuts that we're estimating here at Bloomberg.
Those four nations account for about a fifth of all oil supplies in this world. Those cuts alone account for about 6%. What I'm curious is how quickly they can get these supplies back online. In other words, even if this conflict were to end now, how long will it take? And I think that those are the questions that people are analyzing to understand what some of the scars could be.
Brent crude down by 6 to 7% so far this morning, 92.40. Coming up this hour, Kevin Foley of JPMorgan with stocks seeking to sustain momentum. Tom Fitzgerald of TD Cowen cutting his outlook on the airliners, and Abigail Watt of UBS looking ahead to tomorrow's CPI print. We begin this hour with stocks lower and crude falling on hopes the war in Iran may be nearing an end. Kevin Foley, the global head of capital markets of JPMorgan Securities, writing, despite the move in oil prices, most are taking an optimistic view of the situation. Kevin joins us now for more. Kevin, good morning.
Good morning, John.
Are capital markets still wide open?
They're very much open. You've seen a number of deals launched this morning. We continue to see good demand out there. There's been a rotation in terms of where the interest is, but deals are getting done. We're on the tape in both investment grade, leverage finance, and within equities, all with issuance today.
We were somewhat surprised by this headline coming from Amazon. I don't know if you can speak to it directly, but perhaps you can talk about it in general terms. Kicking off an 11-part US investment-grade debt offering. There's an issue in euros as well. The timing of this, what are your thoughts on things?
Well, let's look at investment-grade spreads since the announcement. We're actually tighter. On a spread basis, we're tighter since the announcement on our end. We're only 14 basis points off the all-time tights. So you're sub 100 basis points on a spread basis for investment grade. That's as attractive as it can be. Give you some context. When the Ukraine happened in the start of February 22, spreads gapped out to 168 basis points in high grade. Again, we're sub 100 basis points right now.
You said there was a rotation going on. Are these AI giants considered havens more so now or less so now? Because I can't keep track of the narrative.
I think the giants are still viewed as havens. There's still a growth story there. There is what you're alluding to is that there's an AI disruption theme that's out there. And it's more looking at that second and third derivatives of who's going to be negatively impacted. So a lot of business is going to benefit from AI efficiencies, but the data centers are still key to this. The hyperscalers still are key. The growth is assumed to be there, and the CapEx spend is happening.
You talk to a lot of issuers, and it's fascinating. If you talk to market participants, we've all seen the sky fall about 15 times so far this year, and it's just March. And I'm just wondering why they've been so resilient to some of the things that market participants are worried about, whether it's higher inflation, whether it's a labor market that's cracking, whether it's some of the disruption tied to AI that could potentially lead to defaults.
Well, I guess the old adage, market climbed the wall of worry, but I think it comes down to liquidity, right? Particularly when you look at the debt markets, you look at the issuance that we've had over the past couple of years, we've very much been recycling capital. 75–80% of the activity that we've had over the past couple of years in the debt markets has been refinancing driven. We haven't had the M&A boom in terms of needing financing to fund all of that, sopping up that liquidity. I think you still continue to have a lot of cash in the system. You look at the equity markets, you've had a shrinking base of public companies. So that also helps, shorten the supply in terms of just keeping demand strong.
That might change this year. OpenAI, Anthropic, SpaceX. What's your view of the next 12 months?
We're continuing to forecast $200 billion of IPO issuance globally, and which is up over 30%. In the U.S., we think it's 60 to 70 billion. There could be upside. There are as much, as you mentioned, there's rumors about some other bigger size ones that could be in there that could move that number higher. Obviously, if the situation in Iran continues or escalates, that could change that outlook right now. But right now, we continue to feel good about the rest of the year.
Kevin, what is it about the situation in the Middle East that could upend that? What is it about it specifically?
Oil, right? You were talking about it. I think you had mentioned nothing straightforward about it. The pressure's there, right? It could complicate from an inflation picture. We continue to assume that the market right now has got an 80% chance of 2 cuts this year. Actually, the JPMorgan Research House view is no cuts this year. Does the pressure from oil pinch the consumer? Does it put inflationary pressure, keep the Fed on hold? Does that somehow derail the growth story?
Are you seeing any parts of the capital markets structure, any companies that are feeling this more acutely, the threat of some of what you just explained?
It's still too early, right? The market is making bets about things and making assumptions, whether you get into the AI disruption story to impacted by energy. But we're not seeing signs of distress, right? It's, I think your prior guest mentioned about balance sheets being healthy at a corporate level. We continue to see the same thing.
You mentioned that we haven't seen over the past couple of years the level of M&A as well as IPOs that we have been accustomed to. This was supposed to be the year that we were going to get all of these things, as John was alluding to. Do you still think that that's plausible, particularly on the M&A side? We touched on IPOs. Or do you think that that's going to have to get pushed back due to the sort of rolling cycle of crises?
Well, I'll clarify my points on M&A. M&A has been up, but it's been much more with elevated stock prices and healthy balance sheets. A lot of it has not needed financing from the debt markets. So activity has been more muted in the financing markets. Yeah, the M&A story, still everything's in place for it. But we've got to see how things play out. We haven't written that here, this isn't the year. But you're right, 2026 was supposed to be the year we were going to go gangbusters in M&A and a lot of pent-up demand. We still see activity levels. We underwrote a deal last week that got announced. We're continuing to commit capital to things. We're not throwing in the towel about that still being a good year for M&A. But obviously, if things persist or escalate, that could derail it. We saw after Liberation Day, we saw a bit of pause in activity, and things really then picked up in late July through the rest of the year. So we could see same dynamics here.
Just getting an important headline I want to bring you. It comes from the UAE. And I'm just to jump in and break this. This is the largest refinery in the UAE. It has stopped as a precaution following drone attacks. That refinery has the capacity to process about 900,000 barrels a day of oil. So that's serious business there. It stopped as a precaution following a drone attack. This goes back to a theme we've discussed throughout this morning so far. The hope that we can end this war quickly, encouraged by the words of the president in the last 24 hours and the facts on the ground. And we keep tracking the facts on the ground right now. And they're the kind of things that speak to the kind of issues we've been talking about for the last week. The problem supplying this market right now with crude and oil product.
And the problem being in the United Arab Emirates right now, the fact that this is, again, spreading throughout the region also raises a specter of uncertainty of what type of response there could be. Is it going to come on the part of people in the Middle East withdrawing investments to try to pressure an end to this? Or is it going to come from pressuring Iran to really throw in the towel as well? I mean, honestly, there's so many variables here.
Kevin, can we get your thoughts just to wrap things up on the Middle Eastern sovereign wealth funds as a pool and a source of capital for some of the deals we've seen over the last few years, and the prospect of that being threatened by these developments?
Well, there's two ways of looking at it. And with a higher oil price, that means going to be more profits coming out of the Middle East. So there actually can be an argument that there's going to be more capital flowing into some of the things. Now, of course, it depends on what your production levels are. If you're getting shut down from some of that stuff, that's going to change the picture. But I go back to my earlier point about liquidity in the overall markets. We look across the entire system, and there's lots of liquidity. So we're not worried about capital disappearing and certainly capital for investing. But yeah, I think that I look at a broader economic concern with oil, right? What does it do to the consumer? What does it do to inflation pressure that gives the flexibility to the Fed to support what they want, what the market is expecting?
Kevin, we're lucky to have you with us this morning. Thank you, sir.
Great. Thank you.
Thank you very much. Kevin Foley there of JPMorgan, tracking a number of things, including that headline that just crossed, also tracking a briefing at the Pentagon. Bloomberg's Tyler Kendall's been following that. Tyler joins us for more. Hey, Tyler.
Hey, John, good morning. Well, the Pentagon briefing is ongoing, but we've heard so far from the Defense Secretary Pete Hegseth saying that the U.S. will, quote, not relent in its operations against Iran until full U.S. military objectives are achieved. He reiterated that those include the U.S. dismantling Iran's ballistic missile program, as well as the industrial base that creates those missiles, destroying Iran's navy, and making sure that Iran will never be able to achieve a nuclear weapon. He then added that the mission would, quote, happen on the U.S.'s timeline, adding today that we will see more intense bombardment. Paired this with recent comments this morning that we've been discussing on the program coming from Iran, including Iran's parliament speaker saying that the country is, quote, absolutely not seeking a ceasefire. We'll continue to monitor these developments, John, but I will quickly mention we're also looking to see whether or not the Pentagon outlines any additional details about it seeking a supplemental funding package from the U.S. Congress amid reports coming from the Washington Post this morning that the U.S. spent $5.6 billion in weapon stockpiles in the first 2 days of this conflict.
Tyler, it's good to see you. Keep tracking that for us, won't you? Stay close. Tyler Kendall there of Bloomberg, tracking a briefing from the Pentagon ongoing. We'll keep bringing you the headlines from that. We'll bring you the headlines as well from what's happening on the ground in the Middle East. So as the Defense Secretary Pete Hegseth says that today will be the most intense day of strikes, and we're seeing headlines that back that up. We're also seeing this headline coming out of the UAE from the country's largest refiner that they've had to stop as a precaution following a drone attack. We'll wait to see how quickly they can restart. But ultimately, that's a unit that can process 900,000 barrels of oil every single day. This is real output being taken out.
Yeah, and from the Abu Dhabi authorities, the post that they put on X, I thought was really telling. They said that they were responding to this fire. No injuries have been reported at this time. And then they added this. The public was reminded to obtain information from official sources only and to avoid spreading rumors. To me, this indicates just how much people feel in the dark and how difficult it is to get accurate information on the ground about what seems to be a very quickly moving story.
Futures this morning just backing off. We're down by about a third of 1% on the S&P 500. Up next on the programme, the morning calls. Plus, Tom Fitzgerald of TD Cowen cutting his outlook on the airliners, a sector that has been beaten up big time over the last week. That conversation up next. Live from New York City this morning. Good morning.
The opportunities are there when you have a market that's swinging $20, $25, $30 a barrel. You have to keep your stops extremely short, your positions extremely small to get in and to get out. We've had a lot of upheaval in these markets over the last 2 generations. We've never seen anything like this.
That was Stephen Schork of the Schork Group weighing in on the energy crisis developing in the Middle East, and another headline reinforcing just how brutal things are on the ground right now. This from the UAE, the largest refinery, stopping as a precaution following a drone attack. That refinery with the capacity to process 900,000 barrels of crude a day. That's an important development. We'll keep tracking that. Also, this came a little bit earlier. It came from Amazon. The timing's interesting. They're kicking off an 11-part U.S. investment-grade debt offering. We understand they're targeting 25 to 30 billion in dollar bonds and also 10 billion euros in the euro offering at the same time. That headline just crossing moments ago.
Listen, Kevin Foley, the head of capital markets at JPMorgan, just said that capital markets are very much open and that tech giants are still havens. So at a time when you haven't seen spreads materially widen out and people are looking for havens, the promise of all of the AI bots that are going to fill your rooms with all sorts of new information and purpose it clearly seems like something people want to get behind.
We'll keep tracking that. The issues have come over the last number of months, including from Alphabet, and they've been met with tremendous demand. The number, $25 to $30 billion in dollar bonds from Amazon, 10 billion euros in euro bonds, in euros. That offering coming a little bit later. That's the price action and some of the headlines. Let's get to your morning calls. First up, Bank of America reinstating Qualcomm at underperform, citing lukewarm growth prospects. Elsewhere, Baird lowering its price target on Oracle ahead of earnings this afternoon. The analysts looking for details on AI infrastructure. And finally, Morgan Stanley upgrading CrowdStrike to overweight, saying the firm is well positioned to outperform in the coming years. That stock is up in the pre-market by about 2%. Elsewhere, airline stocks have been falling as oil prices rise due to the war in Iran. Tom Fitzgerald of TD Cowen cutting his price target on the major carriers, writing, "We assume the airlines are able to recapture a portion of the spike in fuel prices, but it's hard to envision margin expansion this year, barring a rapid decline in energy prices." Tom joins us now for more. Tom, welcome to the show. Which airline right now do you think is most exposed?
I would say probably either American Airlines or JetBlue or an Alaska. All three of those airlines have a little bit more sensitivity in their model to fuel prices for various reasons.
And Delta, where do they fit in here?
They have the most buffer because they own the refinery in Pennsylvania, so that provides an operational hedge. If you look back in 2022 when there was the fuel spike around Russia-Ukraine, over the full year the refinery provided about almost a quarter of a cent of a reduction on their average price paid per gallon of fuel for the year. So it doesn't bail them out, but it certainly helps in an environment like this.
We've had this conversation 50,000 different times. Why is Delta so much better at this than everybody else?
They play the long game. They're not afraid to buck consensus. When they bought the refinery, they bought kind of, I want to say late 2012, so it was viewed as kind of missing the market at that point in time. But you hang around. It's like fashion. You hang around long enough, eventually it comes back into style. 2022, it was good to have the refinery. This year, it was good to have the refinery. They're very focused on building durability into the model in every which way, so not surprising for them.
Having a refinery seems to be the hedge of choice for Delta. How many of the other airlines are actually hedged against oil price fluctuations?
None of the U.S. airlines are. Air Canada hedged about just a little under 20% of their first half consumption. The thing U.S. carriers found was the hedges. It was great during the fuel spike year, but they often ended up losing money when fuel prices declined. And it was advantageous to have everybody pricing on the same cost curve and just trying to manage, not just sitting idly back and actually working to pass on their input costs to the end markets.
When we talk about the airline industry, Tom, we're talking about a twofold hit here. On one hand, appetite to travel amid uncertainty. On the other hand, a question about how much higher oil prices are going to eat into margins. Which do you think is the main driver right now of the price action?
Right now, it's fuel. I mean, I think if there was any signs of demand destruction on top of elevated fuel, you'd see much more. I think you'd see much more weakness in the share. But just at a high level, if you think about when airlines were issuing guidance back in mid-January, the fuel prices in the forward curves were around, call it $2.30, $2.40 a gallon, depending on your estimates on which curve you looked at. Today, those curves are all about, above $3 for the rest of the year, maybe a little bit under $3 now with the easing we've seen overnight, but still a pretty meaningful delta if you have that type of going from, $2.30 to $2.40 to closer to $3 per gallon for a line item that's about 20 points of margin. You can't sweep that under the rug.
And Tom, it's a big market. There's space for different views. Here's a different view. It comes from Barclays. While the focus is on fuel prices in the near term, we note US travel demand appears favourable as the industry heads into the peak spring break travel period and set against lower industry capacity growth. What's the counterpoint, Tom, to that this morning?
I don't know if I necessarily disagree. I mean, I kept my buy ratings on these names, especially the big airlines. I still think you'd want to own them, and that a lot of investors are under-owned overall. If you think about how much improvement has happened in this industry on a fundamental basis versus today and versus pre-COVID, I just think I don't know. The issue I grapple with is numbers are probably still a little bit too high, especially 1Q, possibly 2Q. So I don't disagree. We're seeing the same strength in demand, but there's a lot more uncertainty now in where margins settle out, just given we don't know where fuel is going to settle out. We don't know if there's any impact from higher gasoline prices. So it seemed prudent to take down numbers a little bit, even though I don't disagree that it's probably a good entry point for the stocks longer term.
Well, as you indicate, Tom, that's a massively important variable. The thing we're wrestling with, the thing we're grappling with on a daily basis right now is that anxiety around the labour market seems pretty high at the moment. At the same time, you're going to get tax refunds, and we're trying to figure out where the refunds are actually going to go. Will they buy that flight? Will they take that trip? Or will they just save that money?
I think, prior to the last week, we were going in expecting that there'd be, booking the flight, booking the cruise, spending it on discretionary services. This kind of raises a new wild card. We'll see. I think, and maybe we have more of a keeping up appearances, some spending surge this summer, and it pays off more later on in the year. But I think, all the signs on demand have been pretty encouraging thus far, and travel demand's been resilient. So knock on wood, I think.
And part of that is because it's the upper part of the K. One of the things that's driven the margins at the likes of United and Delta has been international travel. I mean, this is something we haven't talked about yet. The international travel could get disrupted based on the Middle East hubs that have been seriously impacted. Are you seeing any fallout from that you think has longer legs?
Not, at least not for the U.S. airlines. In fact, United noted that they've seen a huge uptick in passengers from Australia, New Zealand, flying to Europe and connecting to the U.S. now instead of connecting through the Gulf. So that's an interesting positive incremental. I think it's too soon to say on bookings. Our early checks have been that they haven't seen a big any fall off in U.S. outbound demand, but obviously, if the situation worsened or there was, consumer discomfort or on traveling into that part of the world, into the Mediterranean, maybe you'd see a little bit of fall off. But I don't think anything to worry about thus far.
It feels like this group is at the epicenter of crisis after crisis, whether it's what we saw in 2020 with the pandemic, whether it was 2022 in Europe, or whether it's what's happening right now. How much more resilient are the balance sheets now than, say, 2019?
It varies carrier to carrier. Delta, United, and Southwest have the best balance sheets among the group. American and JetBlue are the most levered. That's also partly why they take a little bit more of a hit on these spikes of fuel because they don't have as much cushion. So it varies carrier to carrier, and that's been part of the bull thesis, especially for Delta and United, is that the balance sheet resilience should give equity investors more comfort that they can withstand a downturn, that they don't have to dilute shareholders whenever the next crisis hits.
Tom, it's good to see you. Thanks for jumping on. Tom Fitzgerald there of TD Cowen. Out of all the airlines, it would be Delta with the train refinery over in Pennsylvania.
That's a very pure play in terms of a hedge rather than just buying hedges.
It's just absolutely ridiculous. They just keep executing so well compared to everybody else. The facts on the ground, we keep talking about the facts on the ground right now. Chancellor Merz of Germany saying they're concerned at the apparent lack of a plan on how to end the war with Iran. Just compare that reality check to the hope that this market has, given the encouragement they've had from the President of the United States on the US's ability to end this soon. It's a very different take coming out of Europe this morning.
Out of Europe, as well as on the ground in the UAE, where there's discussion of a fire near a refinery that accounts for a significant point of their oil.
Coming up on the program, Abigail Watt of UBS looking ahead to tomorrow's must-watch CPI print. Some notable headlines in financial markets. The number one in the Middle East, the UAE, was dealing with a fire earlier on this morning following a drone strike. And we saw this headline cross just moments ago that the largest refinery has stopped as a precaution following that drone attack. That refinery has the capacity to process some 900,000 barrels of oil per day. And as for oil production, we've seen those cuts across the UAE, Kuwait, Iraq, Saudi Arabia total close to 7 million barrels of oil per day. That's a problem right now. It's a problem for access to energy and ultimately a problem for the price of energy as well, even with the encouragement from the President of the United States more recently that they can end this war and end this war quickly. The price action looks like this. Brent crude is down by about 5%, so off session lows. Brent at the moment at about 93.80, WTI around 91. That's the commodity market. In the equity market, equity futures negative by 0.4% on the S&P 500. And if you want a headline from the credit market, corporate credit, it's this one right here. Even in this moment, as we've heard a few times, and Lisa said it herself, investment grade credit spreads right now are still pretty tight. And Amazon is kicking off an 11-part US investment grade debt offering this morning. Also, an 8-part offering in euros. And those numbers sound like this: $25 to $30 billion in dollar bonds and 10 billion euros in the euro offering.
Yeah, last time around, their bond issuance was oversubscribed many, many times. A lot of people seem to think based on the notes that I've been getting, that this will be similar, is because this is ultimately a haven play. If you take a look at all-in yields for investment-grade bonds, it's 4.87%. That's the all-in yield. That's down from a recent high in April during the whole question of Liberation Day of 5.5%. So you are seeing pretty suppressed benchmark borrowing costs, even amid this crisis.
Someone we both follow and follow closely, Robert Schiffman of Bloomberg Intelligence, leads our credit team here at Bloomberg. Just the headline of his piece he just published. Amazon, huge bond deal to draw massive demand. And that really sums things up, and we've seen that a few times, including from Alphabet and others. As we count you down to the opening bell, about 60 minutes away, let's get you some morning movers, some single names. Danny Berger has more. Hey, Danny.
Hey, John. Starting you off with some sell-side action. Bank of America reinstating Qualcomm at an underperform, pointing to the tepid growth of the smartphone market plus high memory costs. All of that adding to what they say is some lackluster performance coming from the company. Shares are down 2.9%, or 2.8% rather, following that downgrade. And then we had an upgrade from TD Cowen on Rivian. Shares moving higher in the pre-market by 4.6%. After that, TD Cowen saying that their new SUV, the R2, is surely going to have a lot of demand. They're optimistic about that. And the level of demand they're already seeing out there means that there is an upside to the 2027 assumption for Rivian. Finally, I want to get a check on some of the oil companies that have been whipsawed with the oil action. They have been moving down steadily. Now it's picking up some steam, especially for Occidental Petroleum. Those shares are down 2.9% with a decline in oil prices, a little bit more tepid for Chevron and Devon, but still all of them falling in sympathy with oil prices this morning, John.
Danny, thank you. Thanks for the update. Looking forward to the programme. Danny Berger, Matt Miller taking over in about 27 minutes' time to guide you into the opening bell. For this market, some optimism building in the last 24 hours. I'm going to end to the war.
On Iran, you called it an excursion. You said it would be over soon. Are you thinking this week it will be over?
No,
Are you talking
but soon.
about days?
I think soon.
Okay, and with respect
Very
to...
soon. Look, everything they have is gone, including their leadership. In fact, there are two levels of leadership, and even actually, as it turns out, more than that. But two levels of leadership are gone.
The president's comments whipsawing crude. Oil seeing its biggest intraday swing on record in yesterday's trade. Bloomberg's Mike McKee joins us now for more. Good morning, Mike.
Good morning, John. Well, it's very difficult to figure out where the economy is going to end up because we don't know actually when this war is going to end, despite what the president says. And we don't know when oil prices will come down. If they do, they are still high compared to where we were back in February. And that's going to cause a lot of confusion. And much is going to depend on the timing of this all. Now, the impact on the economy you can sort of quantify if you leave out the time piece. We have gotten a lot more efficient with energy, so the impact on GDP is a lot smaller. You've heard the stagflation talk, but instead of the kind of impacts we had in the 1970s of 0.5% to 1% in terms of GDP, now it's only 0.1%, maybe 0.2% in a quarter. And remember, this war started in the third month of the first quarter, so there probably won't be much effect at all. We use a lot less energy to produce the amounts of electricity and power that we get, and we still are the world's largest petroleum producer. So we still have plenty of energy. It's just that it's a globally traded commodity, so the price goes that way. Who gets hurt? Now, this is not a stock prediction. That's Danny Berger's job. But in terms of how it filters into the economy, the airlines and trucking really going to feel it first because they've got to buy jet fuel and diesel, and those have gone up in price. And because trucking is more expensive, you're going to see some prices tacked on, raised at the retail level. Restaurants also, they get a lot of deliveries, and food prices that are going to go up because of imports. And then you get into the things like the chemical business. They use a lot of petroleum. Plastics the same. And so down the road, a month or two, we could see an impact on all of those companies. The positives, despite what Danny said just a minute ago, oil producers and oil field service companies, because they get the direct benefits of the higher prices. And ordinarily you would say renewables, solar energy, wind energy, but the president is trying to kill those, so they're not going to gain as much. Sum it all up, and what do we think? Well, we just don't know, and that is demonstrated by the December Fed funds futures contract, because that's supposed to price in where we are at the end of the year. And it has been very volatile. As you can see, it was going up. We were looking at no moves at all. Then all of a sudden went down when the president said we might end the war soon. And now it's back up again today. People are still thinking that we might see some reason for at least holding the entire year.
Mike McKee, thank you, sir, with the update. And of course, the story far more important elsewhere to the Europeans and to the others. We've seen big moves to the front end of the UK curve, particularly in yesterday's session, erased some of that. But the sense is that they are way more sensitive to these moves than maybe the Federal Reserve is.
They're a lot more exposed in terms of the region to Middle East energy supplies, as well as, frankly, single mandate central banks that have a much more direct pass-through from some of the higher energy prices into what consumers pay and, frankly, into inflation.
Yields lower in the UK this morning. We're down by about 5 on 10s on 2s. We're down by close to 8. Abigail Watt of UBS writing this morning. Energy prices pose a near-term headwind to real consumer spending. The oil price shock is a more two-sided risk for monetary policy rather than is perhaps appreciated. Abigail joins us now for more. Abigail, good to see you and good morning.
Good morning.
What did you mean by that last slide?
So I think if we think about the repricing we saw off the back of the increase in oil prices in bond markets and expectations around easing from the Fed this year, I think you saw obviously a clear focus on the inflationary impacts of the oil price increase. And I think perhaps what's underappreciated is that this is coming alongside a point where the labour market looks a little vulnerable at this juncture still. And it's also coming alongside potential growth hits, right? Like this is something that could hit real spending, which is 2/3 of the US economy. So I think perhaps the point around risk to rates being more two-sided is this idea that it could come at a juncture where the labour market's already looking relatively vulnerable, and the inflation shock, it will depend on the persistence of the increase in prices.
This is something we've been exploring all morning. We talked to Kathy Jones about it. At some point, there's a tipping point. This starts to become bullish for bonds because of the potential output hit that we could see from higher energy prices. How close do you think we are to that tipping point?
I think this is one element of the consumer story, right? I think one of the things you've got to think about is the kind of other drivers that we had for the kind of strength that we were expecting from the consumer this year, right? We're expecting that you see a strong tax refund season. Tax refunds are up 10% in the latest IRS data on an average basis. That's a little bit behind, I think, kind of some expectations of the fiscal stimulus, but that's another thing that should prove potentially supportive for household balance sheets. And if we think about kind of how this feeds through to household balance sheets as well, I think it's the kind of everyone outside the top 20% of the kind of income distribution potentially that's going to wear this kind of more. So I think you've got to weigh potential kind of positive headwinds, positive tailwinds for the consumer versus some of the kind of negative impacts potentially from higher oil prices. So I think it will depend on how those kind of play out in the next couple of weeks and months. And I think the key thing here with all of the kind of potential impacts for the economy from the oil price increase is really the extent and the persistence of that increase in oil prices. And I think that's what's going to be key in terms of how this feeds into kind of growth and also into inflation.
One of the tailwinds has also been the idea of rate cuts. How much is there momentum in the consumer, particularly at the lower end, should the Fed remain on hold?
Yeah, so I mean, in our expectations, we've got 50 basis points of cuts from the FOMC this year. And in terms of the timing of that, we think it's potentially kind of second half, so July, October. I think at the margin, that easing in interest rates is something that is supportive and helpful for the consumer. But that would, in theory, bring interest rates back round to around neutral. It doesn't necessarily outright stimulate the economy at this point. I think for us, when we're thinking about the kind of resilience and the potential strength of the consumer, I think that fiscal story is actually potentially the more important part of the kind of outlook this year for the consumer, rather than necessarily the kind of tailwind from monetary policy easing.
We've been talking about how that fiscal tailwind could potentially be absorbed by higher oil prices. How do you sort of weigh where oil prices are versus that fiscal boost that people were expecting?
Yeah, so I think it's probably one of the key things to be thinking about at this juncture. I think, as I said, I think the kind of persistence and the increase in kind of oil prices will be important. We've obviously already seen gasoline prices rising, and the consumer in the US is incredibly sensitive to higher gasoline prices. So I do think, there is a potential that some of the positive kind of tailwinds we were expecting from fiscal policy could be offset, in particular for those lower income consumers where, you are seeing the fact that savings are running kind of below average. They've kind of spent down any excess savings that had been built up. And I think, that's the area where I would think that you would feel that kind of gas price increase most acutely in the consumer.
Mike McKee was talking about where Fed fund futures were trading right now. What's your Fed bet for you and the team?
So we're expecting that the Fed deliver 50 basis points of cuts this year, right? Okay. I think the risk, if we're thinking about the distribution around that, I think, potentially if you see kind of more of a growth hit, if you see this kind of labour market vulnerability persisting, I think that you could potentially see the risk that rate cuts come sooner than we're expecting. And then I think, if we think about the kind of risks on the opposite side, the potential for rates coming later and them holding longer, I think that's really going to depend on what we see in the inflation data. Obviously, we'll get the February CPI this week. We're expecting that you see a slowing in terms of the monthly prints there, but we do think that will be the low point for the CPI this year. So, we're expecting that pushes higher and we see inflation peaking in the second quarter.
Independent of what happens in the Middle East, that's the low for this year?
Yeah, so that was our profile previously as well, because we're still seeing that tariff pass-through coming through. You are seeing kind of elevated core goods price increases, even if you are seeing a little bit better inflation on the services side.
So the call for 50 basis points, is that a call based on the economy or the man who's going to be the Fed chair?
So it's based on the idea that, if we think about when we're thinking we see inflation peaking, we do think that the run rates of inflation will begin to peak in the second quarter. And I think at that point as well, we're expecting that the labour market still looks vulnerable. We have the unemployment rate pushing higher from here to 4.5, 4.6 by the summer. So I think with that dynamic, I think that's a point at which in July you should see kind of enough inflation progress for them to think, OK, we should remove a little bit of that excess restrictiveness.
Got it. Abigail, good to see you. Thanks for breaking it down. Thank you. Abigail Watt there of UBS. So we see unemployment climbing through the summer potentially and into the midterms. Ultimately, it's going to be the political framework there. That's not great reading. Won't be great for the administration to hear, and won't be great to see if that's how it plays out.
Especially after what we got with the job report that we got on Friday, which seemed to confirm that. I do wonder how important CPI and core PCE are going to be this week, given you need to see that progress in inflation to allow this to happen.
Brent crude this morning is down by 6%. We're at 93. WTI is down by about 5. We're at 90 so far this morning. Up next, we'll set you up for the day ahead. Plus, Jim Caron of Morgan Stanley joins us, remaining confident the markets can get back on the right track. That conversation just around the corner from New York City. You're watching Bloomberg TV.
Today will be, yet again, our most intense day of strikes inside Iran. The last 24 hours have seen Iran fire the lowest number of missiles they've been capable of firing. We will not relent until the enemy is totally and decisively defeated.
That was the Defense Secretary in a briefing at the Pentagon just moments ago, weighing in on the facts on the ground and where the operation currently stands, as many of you would call it, on where the war currently stands. In the commodity market, this is how the price of things is shaping up right now. Brent crude is down by 7%, WTI is down by 6%. The facts on the ground, drones, projectiles still being thrown into Gulf nations from Iran, and it's doing damage. And we see that in the UAE, intercepting, at least attempting to, a series of drones and missiles once again today. One hitting the biggest refinery in the country. They've had to stop as a precaution. We've talked about the size of that, the capacity to process 900,000 barrels of oil per day. A lot of energy production and output is being taken out in this region.
Yeah, we've gotten already 6% of the output taken off, the 6% of the output in the world, right? I mean, this is 6.7 million barrels from 4 nations of 20 million barrels per day that is produced. This is a crucial area of oil production for the world. When do we start talking about the fundamentals of what's being taken offline and how long it's going to take to put it back on? Until we get a timeline, we can't even go there. And I think that is the level of uncertainty we have.
Some vicious, volatile moves in global markets in the last 24 hours as we count you down to the opening bell. The start of another one. It's about 42 minutes away. Here's the trading diary for the week ahead. After the market close, earnings from Oracle. Look out for that tomorrow. CPI data. Plus, we'll hear from the Fed Vice Chair of Supervision, Mickey Bowman. On Thursday, Dollar General earnings, the U.S. trade balance, and another round of jobless claims on Friday. Core PCE and UMich consumer sentiment. For stocks, they're searching for direction as President Trump signals the war in Iran might be nearing its end. Jim Caron of Morgan Stanley writing, our base case remains that strong fundamental underpinnings in the economy plus easier fiscal policies will allow for prices to resume higher. Jim joins us now for more. Jim, good morning.
Good morning.
Still constructive?
I am still constructive. It's not going to be as easy as it sounds, though. I don't think it's going to be a straight line. I think that we do have to recognize what the initial conditions in the markets were prior to the event of the war and what they might be coming out of it. Look, in my career, I've experienced 3 of these. This is my 3rd one. The first one in the early 1990s, Gulf War I, Gulf War II, early 2000s, and here we are again. Each one of these events absolutely caused volatility, but the difference between this one and the last 2 was that the initial conditions coming into the markets today with a lot of fiscal stimulus, we have a lot of tax refunds coming in, we have relatively low interest rates. I think inflation obviously is under pressure right now, but it was headed down. Jobs data, confidence data, a lot of things were going right. And I do think that we will be able to put this behind us at some point. The question is, how long will this all last? Because I think the duration's a big point. What, if anything, breaks, and how long will it take to repair? And that's really what the risk is.
You seeing anything break?
Well, I mean, I think we're seeing signs, right? So the way that I look at this is that there are 3 basic risks that are out there. The first one is correlation risk. So first of all, and the second one's liquidity, and the third is contagion. So the correlation risk right now is that you're having equity prices come down and you're having bond prices come down. So there's no place to really hedge yourself, and that creates a scary situation in markets. But liquidity is still functioning relatively well in markets. Markets are functioning well based on repo markets and things like that. And contagion, we're not really seeing this become a broad-based wave of defaults coming through the markets because of this energy shock. So I think there are 2 out of these 3 reasons. The liquidity and the contagion component are okay for right now. The correlation risk, though, is relatively high.
And we've seen some pretty big losses being reported, at least by Bloomberg, in terms of certain hedge funds in particular. Bloomberg reporting Millennium, Balyasny, and Point72 among them. Are you seeing forced sales that are opportunities to really get in there?
Well, see, that's what we're looking at, right? So we came into this relatively well balanced in our portfolio, somewhat high quality and defensive. So for us, this has actually not been as big of a shock to our particular management and our portfolios. So we are looking, from my perspective, we are looking at opportunities to find dislocations in the markets to add to some of the themes that we really like. Cyclical broadening in the market's one of those. So and that's what we're doing.
So at what point does cyclical broadening get challenged by higher oil prices and a potentially weaker growth outlook?
Listen, that's a great question. So what we see right now is that there's an inflation shock hitting the marketplace. Right, that's why bond yields are moving higher and equity prices are going down. The risk is when does this inflation shock translate into a growth scare, and when does it start to really impact growth? That's when the cyclical broadening trade will start to get challenged, because cyclical broadening really means small caps and mid caps relative to large caps. That's usually what does well. That's what was working prior to this event. So do we get back into that right now? And that's what we have to ask.
Why do you think it hasn't already been challenged by the fact that we've reset oil prices higher and potentially put the Fed on hold for a longer period of time?
Yeah, so the reason I think that is when we look at oil prices, I don't think they're going back down to where they were. I think that they're going to settle at a higher level than where they were. So if you're looking at Brent, we're not looking at $70 Brent going forward. We're probably looking at best case scenario somewhere around like 80, I think, for this year. So I don't think that the shock just goes away, right? I think that we're taking the growth hit. We are going to get that. We are taking probably higher inflation right now, and the market's repricing for this. So the question is where is the market repricing? Where is that overshooting? and does it actually give us an opportunity to enter? And we think that there are some selective opportunities where we can get involved. And I don't think that we tip ourselves into a recession necessarily. Now, clearly anything can happen and we'll react to it. But for right now, we think that this is still volatility in markets that we can take advantage of.
What are the openings right now? You call them dislocations. We're single digits away from all-time highs.
Yeah,
on the S&P. Where are the openings?
Yeah, exactly, and that's what we debate, right? You know, is we're sitting here saying, well, you know, we do want to buy something relatively cheap, but nothing's really cheapened a whole lot. But you know what, John? That's actually a relatively strong sign for the markets, that the markets aren't willing to really take this down. Now, some people will say, oh, the markets are completely missing this. I don't believe the markets are that dumb. I think the markets are pretty smart. I think it really depends where you are. So the cyclical broadening theme, I still think, is a very strong theme. I think a lot of the technology sector has already come in relatively weak and relatively well discounted going into this. So it's not like we came in to this event where everybody was way overbought, way overlong at the moment. So I think we have to be a little bit less emotional, and we have to think through the valuations and where the opportunities are. And to your point, we're not seeing screaming buys at this point. So we're being slow, but we are starting to add.
Jim, it's good to see you. Jim Caron of Morgan Stanley Investment Management, still constructive on this market and seeing the ability to add as we get these dips. And they are small dips in the grand scheme of things.
They are small dips, but he's not alone. A lot of people saying this is a good opportunity, especially as it does seem like people are looking for off-ramps.
Equities right now on the S&P, negative by about 1/10% going into the opening bell. The president seemingly sending the signal that maybe he's looking for an off-ramp and capping the advance on crude. Crude this morning down by 7%, 92.30, 89.40 on WTI. We've talked continuously this morning about the hope that we can take that off-ramp, establish one, and go down it. And the reality on the ground and the facts on the ground are still deeply concerning.
This morning, the reports of a fire at a UAE or near an UAE refinery, very much concerning. We'll continue to monitor this and figure out whether people come to more of an off-ramp.
Coming up tomorrow, Francis Donald of RBC, Lisa Shallard of Morgan Stanley, Jeff Curry of Carlyle, and the former St. Louis Fed President Jim Bullard from New York City this morning. Good morning. Stay safe. We'll see you tomorrow. This was Bloomberg Surveillance.